Hello, all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we are going to start with our most awaited video, that is the revision of 9 RTPs, 9 past papers and 8 MTPs, total 26 paper compilation we are going to start today. Now before we start with the compilation, I would like to say a few things before we start with our first paper. That is, the very first thing that I would like to say is, whenever I will revise this particular 26 papers, if you find any particular concept important at your end, just make sure that you put a timestamp below the comment box, so that when you want to recap the things, you can directly click on the timestamp and then you will directly jump to that particular section of the video. For example, if something is important at 53 minutes, just put 53:00 in the comment box, and that point, if you click, next time you will directly come to that particular section, so that you don't have to search that concept again and again. This has been very helpful for the students. There has been more than 1300 comments on the video which we have uploaded in the last year. Most of the comments were about the timestamps only. This is the first thing. Second thing that I would like to say you all is regarding this PDF. This PDF I will share once I will upload the second part. Today I am uploading the first part covering 5 RTPs. And next day I will be uploading another part. Day after tomorrow, after that I will share the PDF. Later on I will upload the compiled video of 26 papers together. Okay, at that time I will give you the compiled PDF also of 26 papers at one PDF file only. Third thing, the most important thing that I would like to say before we start with our revision. Whatever we are going to do in this 26 papers, obviously we have done all these things in class. And in class, we have done all these things in our regular batch, exam-oriented batch, and even in our practical question batch in great detail. Here, we are going to complete this particular thing as a revision in 8 to 9 hours, so that on the day of examination, you are able to revise. But in the class, I have explained you each and everything in detail. So we have done all these things in detail, except the latest MTPs and RTPs, which were not there available at the time of doing the classes. Except the latest MTPs and RTPs of May 26, rest all we have done in the class. So be careful that there should not be any confusion that you should not ask me such questions. Sir, if we do this, is it sufficient without doing the class videos? We are skipping the class. Don't do that. If you have a class video, then you do the class video first, complete that. That is in great detail. There I have explained everything in great detail. Suppose a question is completed over here in 10 minutes. There it is completed in half an hour. So just imagine the content that I have delivered over there. Obviously, for obvious reasons, that is class, there we have sufficient time. This is for revision purpose. We are doing this video only from the perspective of, so that on the day of examination you should be able to recap it very fast. Last but not least, one more thing, that there are few more RTPs and MTPs and past papers which are covered in our textbook. Apart from all these are covered in our textbook. Apart from this, we also have, suppose here it is November 22. So in our class book, you will also get May 22. You may also get December 21. So like that, there are few more RTPs which are covered, which will give you more exhaustive coverage. Here we are covering 9 RTPs, 9 past papers, and then you are doing 8 MTPs. Okay, so these are the few things that I had to say before we start our session. Now I will not say anything till our last paper. I will only talk about the content. That's it. Now let us start with our first RTP, RTP November 2022. The very first question over here is on partnership form, and in this question, the partnership form, the examiner has asked us to compute total income and tax payable of the firm. Now, no remuneration is given in this question. Therefore, because remuneration is not given in the question, therefore there is no need to compute any book profit. Otherwise, in partnership firm question, you have to first compute book profit, then you have to compute remuneration, and then you have to compute total income. In this question, no remuneration, therefore no book profit. Directly compute total income. Let's compute the total income. The partnership firm is commenced. They have started with 3-star hotel. 3-star hotel is eligible for 3580, and this associate is claiming also 3580. Okay. Now this entity was set up in 2025. The firm has 2 partners, 2 working partners, and the net profit of the firm is 26 lakhs. Now let's start computing the total income. 26 lakhs is the net profit. The very first item over here is depreciation as per books of accounts, so add back. Second is interest on capital, 15%. 15% not allowed. Only 12% allowed as per 40B. Therefore, 3% add back. 3% will amount to 10 lakh, because 15% amounts to 50 lakhs. Therefore, 3% amounts to how much? 10 lakhs. Add back 10 lakhs. Third one is you have taken some loan from Mr. Rajveer, a resident, and you are paying him some interest on which TDS is not deducted. So if you don't deduct TDS of residents, 30% of your expenditure will be disallowed as per 40A1A. Therefore, add back 30%. After doing all these things, the next point is you are purchasing some fixed asset. You are purchasing one motor car for 7 lakh rupees and you have capitalized the same in the books of accounts. So for this 7 lakhs, you can claim 3580 deduction because you are using this motor car for what? For 3-star hotel. Second, you are also incurring some 2 crore rupees capital expenditure, but out of that 1.5 lakh crore is land. So land is not allowed as deduction under 3580. Therefore, you can claim deduction for only building. Land will not be allowed. Third, you are also purchasing some air condition on 15th of May for 3,20,000 rupees. So that also you can claim as a deduction under 3580. If you do all these things, you will be under loss. Your 3-star hotel will be under losses. So now the question is, you have another hotel, which is a 4-star hotel, which has started 15 years back. In that there is a profit. So the question is, can I set off the loss of 3-star hotel with a 4-star hotel profit? The answer is yes. Because a 3580 business loss can set off only against 3580 income. 3580 income means it should be set off only against the eligible business. 4-star hotel is also eligible business. Don't raise the question that it was open 15 years back. Even if it is open 50 years back, 100 years back, then also you can set off the loss of the 3-star hotel against that 100 years old hotel also. Therefore, you can set off the loss. One more item is given over here that all the expenses were paid by account paycheck. Yes, it is necessary to pay the expense by account paycheck, account pay draft, ECF and such other electronic mode. Otherwise, 3580 deduction is not allowed. After doing all these things, you will get your total income. Okay. After that, you compute the tax. 30% tax, surcharge if applicable. If the income crosses 1 crore, apply surcharge also, and 4% cess. Now, the question is not completed. They have asked tax payable. Now, you also have to compute AMT. Oh, don't forget this. In case a partnership firm other than company, if other than company associate claims any profit link deduction or 10AA or 3580 except ATP, you have to compute AMT also. How will we compute AMT? Nothing. Total income as per the normal provision and add back all the 3580 deductions. Add back this 7 lakhs, add back this 50 lakhs, add back this 3.2 lakhs. And then claim depreciation on this 7 lakhs, claim depreciation on this 50 lakhs and claim depreciation on this 3.2 lakhs. This 7 lakh is what? Is a motor car. Therefore, claim 15% depreciation on this. This 50 lakh is a building. Claim 10% depreciation on this. This 3.2 lakhs is a new air condition. Claim 15% depreciation on it. After that, whatever amount will come, that will be adjusted total income. On that, apply 18.5% AMT. Then surcharge if applicable if the adjusted total income crosses 1 crore rupees. Then 4% cess. Then compare whichever is higher and then find out if the AMT is more, you will get AMT credit also. I hope it is clear to all of you. So this is what this question is all about. Beautiful question it is. Coming to question number 2. Question number 2. What is question number 2, sir? Question number 2 is a classic total income question. Whenever a total income question will come in the exam, always remember you have to check the last line first. What is the last line over here? Check the last line. They have asked to compute total income. They have asked to compute tax liability and also check as per which regime they are asking. They are asking as per new regime 115BAA. Accordingly, question, answer the question. First, always read the last question, last line, that which regime they are asking. Sometimes they put the regime in the additional information also, so be careful with that. Okay. In the additional information also, you should check which regime is asked. So let us start with the new regime 115BAA. Asasi is an Indian company engaged in manufacturing of automobiles. 9 crore 50 lakh is the profit. The very first adjustment is depreciation as per accounts, therefore add back. Okay. Second adjustment, donation to political party paid by account paycheck, not allowed in 115BAA. ATG, ATGGA, GGB, GGC, all these things are not allowed under what? Under what? Under the new regime 115BAA. Next one, you are paying 50 lakh rupees to a scientific research association. So generally scientific research association is allowed as deduction under section 35, but in new regime 115BAA that is also not allowed. New regime, donation to scientific research association, statistical research association, social science association, not allowed as deduction. Next one, you are receiving dividend from foreign company of 15 lakh rupees. So what should I do? Reduce from here and show under IFOs. Do not gross up. Even the word received is written. Whenever the dividend is received from foreign company, ICI never grosses up. ICI never grosses up dividend received from foreign company, always remember. What about dividend received from domestic company? That we will see later whenever such adjustment will come. Next one, long-term capital gains of 4 lakh on which equity share, on which STT is paid. It means it is a 112A capital gains. Because STT is paid, therefore it is a 112A capital gains. Therefore reduce from here and show under capital gains. 12.5% tax in excess of 1,25,000 rupees. Therefore, reduce 4 lakh from here and show 4 lakh in capital gains. And while computing the tax, 12.5% tax on 2,75,000, 1,25,000 exemption. Next is a very intelligent adjustment. You have taken a loan of 4 crore 20 lakh rupees from State Bank of India at the rate of 10%, but on 1st of June 2025. Now, this loan is taken for the purpose of purchasing some machinery. Okay. And the interest on the loan is outstanding on 31st March, which was paid on 1st of December 2026. Now, very important. First of all, you have taken a loan of 4 crore 20 lakhs. The rate of interest is 10% and the interest is payable for 10 months because the loan is taken on 1st of June. Therefore, the 10-month interest comes to 35 lakhs. First of all, do that. What do you do? You disallow this 35 lakhs completely because this interest is not an expense. It is taken for the purpose of asset. It is taken for the purpose of plant and machinery. So, whatever is the interest of 10 months, that is 35 lakhs, you add back that interest. 35 lakhs, you add back. Once you add back that 35 lakhs, now you check the treatment. When is the machinery purchased and when is the machinery put to use? The machinery is purchased and put to use on 1st of January 2026. It means from June to December, that is 7 months, the interest should be capitalized. Now find out the interest of 7 months. 35 into 7 divided by 10, that comes to 24.5. Add this to plant and machinery. Sir, this will be added to plant and machinery and claim depreciation? Yes. But sir, it is not paid, doesn't matter. For claiming depreciation, it is not necessary to pay. Only to claim it as a revenue expense, it is necessary to pay. Sir, balance will not be allowed as a revenue expense because it is not paid. It is paid after the due date of filing of return. Always remember, for capitalizing the interest and claiming depreciation, it is not necessary to pay. Only to claim that as a revenue expense, it is necessary to pay. I hope it is clear to all of you. Therefore, ultimately, what is the treatment? Again, I am saying this 35 lakhs will be added back, and then this 35 lakhs into 7 divided by 10, that will be added to the plant and machinery, and the remaining portion will be remaining disallowed forever. Okay. Forever means whenever you will pay in the next year you can claim the deduction. Next one, there is a profit on sale of land of 8 lakh rupees to PQR Limited. Who is a PQR Limited? This is a transfer of land between 100% holding subsidiary. If an 100% holding subsidiary transfers any capital asset within themselves, then it is exempt provided the recipient should be Indian company. If the recipient is an Indian company, it is exempt. In this case, it is exactly happening like that only. So reduce 8 lakh from PGBP and show under capital gains, write a note that it is exempt. Okay. Next one. You have paid a salary of 1 crore rupees to foreign technician for installation of machinery. So this is related to machinery. You cannot debit to P&L. Therefore, add back to PGBP and capitalize to plant and machinery. Next one. You have sold some goods of 22 lakh rupees to a customer. So I am crediting 22 lakhs rupees to P&L account. Then out of that 12 lakh rupees has become bad debts. So I am writing off bad debts of 12 lakh rupees. Now how much is receivable from the debtor? 10 lakh rupees is receivable. Now the debtor has expired. Debtor died. Debtor is dead. After that we tried to recover and we recover unfortunately 11 lakh rupees. We were supposed to recover only 10 lakh, but we have recovered fortunately 11 lakh rupees. And unfortunately we credited entire 11 lakh rupees to P&L account, which is wrong. You should have credited only the excess 1 lakh rupees to P&L account because 10 lakh is already credited to P&L account when you sold the goods. Therefore, you cannot credit entire 11 lakh rupees once again to the P&L account. Whatever is excess recovered, how much is receivable? 10 lakh. You have recovered how much? 11 lakh. Therefore, excess 1 lakh should be credited to P&L because unfortunately, you have credited entire 11 lakh to P&L. Therefore, reduce 10 lakhs from P&L. That is the ultimate effect of this particular adjustment. Next one, depreciation as per income tax, 1 crore 50 lakhs reduced. Then some additions have been made to fixed asset. Building, which is purchased on 15th of December. Therefore, half depreciation because it is used for less than 180 days, 5% will be allowed. Computer, purchase and put to use on 11th May, full depreciation 40%. Plant and machinery. What is the total cost of plant and machinery? See, it is installed and put to use on 1st of January 2026. 500 lakhs is the basic cost, plus 100 lakhs is the foreign technician salary, plus 24.5 lakhs is the interest which will be capitalized. Therefore, the total cost of machinery is 624.5. On that, you will claim half depreciation because the machinery is put to use for less than 180 days. Therefore, you will claim 7.5% depreciation. And additional depreciation not allowed because you are following 115 BAA. Additional depreciation will not be allowed to you. Last but not least, you are declaring some dividend to your shareholder on 31st of May 2026, which is 1 month before the due date of filing of return. Therefore, as per ATM, you will be eligible to claim deduction. How much? Dividend received or dividend distributed, whichever is lower. How much is dividend received? You can see about the dividend received is 15 lakhs and dividend distributed is 12 lakhs. Therefore, you will be eligible to claim deduction of 12 lakh rupees here. After that, you compute the tax. How many taxes are there? On 112 income, you will compute 12.5% tax in excess of 12.5 lakhs. and rest of the income you will directly compute 22% flat tax, 10% surcharge always in 115BAA and 4% cess always in 115BAA. This is what this beautiful question is all about. Let's go ahead with the third question. This is also very beautiful question. Mr. Rajesh is a resident. Mr. Rajesh is a resident and he is holding some units in PQR and Shipra. Now we need to understand who is PQR and who is Shipra. Shipra is a business trust and PQR is AIF. Always remember, in case I have an investment in business trust, the income is taxable in my hand when the business trust will actually distribute the amount. It means in case of business trust, the investor will be liable on receipt basis. But in case of AIF, the investor will be liable on accrual basis. If the investor, if I am investing in AIF and if the AIF is earning 100 and they are distributing 90, still 100 will be taxable in my hand. Be very careful. Okay. Now let's talk about Shipra first. First of all, let's try to understand the holding structure. Mr. Rajesh is holding in Shipra also. He is holding in PQR also. He is holding in business trust also. He is holding in AIF also. Now, Mr. Rajesh is holding how much? Only 10% units. Okay. And the entity is distributing how much? 90% of their profits to the investor. Be very careful. And Mr. Rajesh is earning the following income. Let's talk about business trust first. First, Mr. Rajesh is earning, the business trust is earning. First, let's talk about business trust. Then we will talk about AIF. Business trust is earning 2 crore rupees dividend from GPL. Who is GPL now? GPL is a SPV of business trust. Now, if the business trust receive any dividend from SPV, that dividend is always exempt in the hands of business trust. But what is the treatment of dividend in the hands of the investor? In the hands of investor, it depends. If the SPV has opted for 115BAA, then it is taxable. If the SPV has not opted for 115BAA, then it is exempt. In this question, see, check below. It is written that the SPV has not opted for 115BAA. Therefore, this dividend income is exempt in the hands of what? In the hands of Mr. Rajesh. I hope it is clear to all of you. What about interest from SPV? Interest from SPV is exempt in the hands of business trust, but in the hands of investor it is taxable. Investor will be liable to pay tax on this. On what basis? On receipt basis. In case of business trust, the income is taxable on receipt basis. So out of 3 crore, how much is distributed? 90%. 90% amounts to how much? 2.7 crore. Out of which Mr. Rajesh holds how much? 10%. Therefore, 2.7 crore into 10% comes to how much? 27 lakh. Therefore, 27 lakh interest will be taxable in the hands of Mr. Rajesh. I hope it is clear to all of you. Third, short-term capital gain on sale of development property. On this, the business trust will pay tax. Investor is liable for exemption. Okay. I hope it is clear to all of you. Now come to PQR AIF. In case of AIF, it is taxable in the hands of Mr. Rajesh on accrual basis. Okay. Now, the very first thing that the AIF is earning is business income. Always remember, on business income, always AIF pay tax, not the investor. Therefore, on this 35 lakhs, Mr. Rajesh will not pay tax. Next, long-term capital losses. That can be given to Mr. Rajesh because Mr. Rajesh is older than 12 months. If the unit holder is more than or equal to 12 months old, then the losses can be given to the losses other than PGBP losses can be given to the investor. So this 20 lakhs, 7 lakhs into 10%, that is 2.7 lakhs. Will be attributed to Rajesh, but Rajesh cannot do anything. Rajesh does not have any other capital gains against which he can set off this loss. If Rajesh would have some other capital gains, he would have set off this losses against it. Therefore, Rajesh will carry for this loss and set off this loss against his subsequent year capital gains income. Last but not least, Rajesh is also earning 52 lakh rupees interest income from AIF. That is IFOs. On this, Rajesh will pay tax. On how much amount? Entire 100%. That is 52 lakhs into 10% share. Now not 90%. In case of AIF, accrual basis taxable is there. Taxation is there in the hands of the investor. Therefore, here Rajesh will pay tax on 52 lakhs into 10%. So 5.2 lakhs will be directly taxable in the hands of Mr. Rajesh. Now, you have to compute tax after that. Tax as per which regime? As per the new regime. What is the new regime slab rate now? So only two incomes are taxable in the hands of Mr. Rajesh. One is 27 lakhs from business trust and one is 5.2 lakhs from interest income from AIF. After that, you have to compute tax as per new regime. What is new regime? New regime slab rates are up to 4 lakh no tax, then 4 to 8, 4%, 5%, then 10%, then 20, 15%, then 20%, then 25%, then 30%. So after 24 lakh, it is 30%. Okay. Now, one more important catch over here in this question is you have to compute tax payable. Tax payable is asked. Always remember, whenever they are asking tax liability, then compute tax and leave it. But when they are asking tax payable, then you have to compute tax. From that, you have to reduce TDS, TCS and advance tax credit also. In this question, Mr. Rajesh TDS has been deducted. Where? At two places. One, on interest income, TDS is deducted at 10% under 194 LBBA, and another on 5.2 lakh, TDS is deducted under 194 LBB. In both the cases, TDS is deducted at 10%. So on this 10% TDS of 2,70,000 and on this 10% TDS of 5.52,000 would have been deducted in case of Mr. Rajesh. So both this credit should also be given. These small things matter in the examination. Okay. So you have to take credit of these two items, and after that whatever amount is come, that will be called as tax payable. I hope it is clear to all of you. Next question we will go ahead. Question number 4. What is question number 4, sir? Pay attention please, all of you. Question number 4 is on TDS. See what happens generally. Generally, if you go to a tour operator, overseas tour package and program, and if you book any tour, then up to 10 lakh rupees, they will collect 5% TCS, and about 10 lakh rupees, they will collect 20% TCS. But there is some relaxation for non-resident. If a non-resident is coming to India for a visit, and then a non-resident is booking a tour, overseas tour package and program, for that there is a complete exemption, remember. So that is what is happening in this particular question. Mr. Devansh, an Indian citizen, is residing in New York. He came to India for a visit. So a non-resident is coming to India for a visit for few days. When he came to India, he booked a tour of 6 lakh rupees to some Malaysia for 1 week. So he's a non-resident coming to India for a visit. He is booking a tour for Malaysia. In his case, the TCS under 206C1G is completely exempt. Therefore, no TCS in his case. I hope it is clear to all of you. Second case. XYZ is a company which is incorporated in the current year. Whether 194Q will be applicable? Absolutely no. If a company is incorporated in the current year, 194Q is not applicable. Why? Because for 194Q to apply, the last year business turnover has to be more than 50 lakh rupees. More than 10 crore rupees. And the current year purchase should be more than 50 lakh rupees. Now the current year purchase is more than 50 lakhs, no doubt about it. But the last year business turnover is 0 in this case because the company is incorporated in the current year. The buyer is incorporated in the current year. Therefore, last year business turnover is 0. Therefore, TDS under 194Q is not applicable in this case. I hope it is clear to all of you. All those things are irrelevant. The very first basic thing is to check the last year turnover. The last year turnover has to be more than 10 crore rupees first of all. Otherwise, this section is not applicable. 194Q is not applicable. I hope it is clear to all of you. Next one, question number 5. Very good question. Mr. Ravi Prakash is aged 52 years. He gifted 30 lakhs to his wife on her 50th birthday. So husband is giving 30 lakh rupees to wife on birthday. What does wife does with that money? Wife purchases a car of 29,52,000, which includes RTO of 2,15,000, insurance of 51,000, warranty of 25,000 and accessory charges of 35,000. Now obviously, wife does not have any other great income. She only has 25,000 rupees rental income. 25,000 rental income is how much? It is around 3 lakh rupees income. On that 30% deduction will be available of standard deduction. Therefore, the net income will be 2,10,000, which is lower than basic exemption limit. The question is wife liable to file the return? The answer is yes. Why, sir? Because wife's TCS is collected by the car dealer. How, sir? Wife has purchased a car of 29,52,000. So 206C1F will be applicable if you purchase a motor car of more than 10 lakh rupees. Of X showroom price. X showroom price will not include all these expenses. X showroom price will not include RTO, insurance, accessory and warranty. Therefore, after reducing all these things, X showroom price is coming to 26,24,710. Therefore, on that, the dealer would have collected 1% TCS, which is around to 26,247. Now, wife is not a senior citizen. It is less than 60 years and it is resident. Therefore, remember, in section 139, subsection 1, it is written, if your TDS or TCS is greater than or equal to 25,000 rupees of a previous year, then you are liable to file the return. And for resident senior citizen, it is 50,000. So for resident senior citizen, TDS, TCS amount collected and deducted at 50,000 is more, then liable for filing return. For others, if it is 25,000 rupees or more, they are liable to deduct TDS. So in this question, the TCS of Miss Sudha is more than 25,000, more than equal to 25,000 rupees. Therefore, Ms. Sudha is liable for what? Filing the income tax return. I hope it is clear to all of you. Next question, Mr. Vijay. Total income is 28 lakhs. AO has passed an assessment order enhancing the income by 5 lakh rupees. Now he wants to file an application to dispute resolution committee for reducing the penalty or waiving the penalty or reducing the prosecution for immunity of penalty and prosecution. There is no order of detention against him. There is no prosecution against him. There is a penalty in the 271D which is initiated against him. So he has a lot of question now. Can he file an application to DRC? The answer is yes. What is the condition to filing application to DRC? Your total income as per your return of income should not exceed 50 lakh rupees, which is not exceeding 50 lakh. and the AO should not increase more than 10 lakh. The AO is not increasing more than 10 lakh. There should not be an order of detention against you. There is no order of detention against me. There should not be any prosecution against you. There is no prosecution against me. There can be a penalty against you. Penalty is there or not, it doesn't matter. All other conditions are fulfilled, therefore he can file an application. Second question, what is the time limit? The time limit is 1 month from the date of receipt of order. The order is received on 26th of November 2026. So 1 month from 26th November 2026 comes to 25th December 2026. This is the last date for giving the application to DRC. Third, if I am not happy with this application, if I am agreed with this application, can I file an appeal? No. No appeal is possible against the order of DRC. No appeal or revision is possible against the order of DRC. Order of DRC is non-appealable. And last but not least, would your answer be different if the AO's assessment order is based on the information received under a DTAA with country X? Yes, answer will differ. It is written in the provisions of 245 MA that if the information is received from foreign authority under DTAA, then the doors of DRC are closed. You cannot come to DRC in that case. I hope it is clear to all of you. Next question is a simple DTAA question. Compute total income, net tax payable, follow the old regime. Miss Rajni, 63 years, therefore she is a what? She is a resident as well as she is what? She is a senior citizen. Be careful. She earns income from multiple places. First, she is earning income from country M, 10,120, so multiply that by 69 rupees. Then she has some house property rental income, $25,000. Minus $200 is a municipal tax, so minus that and then claim 30% standard deduction. Then 15 lakh rupees from performance in India, take that as PGBP income, 4.2 lakhs from bank FD and 15,000 rupees from saving bank. So from this bank FD and saving bank, she will claim deduction under 80 TTB because she is resident senior citizen. Then she has paid 29,000 for insurance of her health and 32,000 for insurance of her husband health. Husband is also resident, so both of them, herself and husband, will get aggregate limit of 50,000 rupees deduction under 80D. Then she has invested some 1.5 lakhs in PPF. She can claim ATC for 1.5 lakhs. Then she has invested 4 lakh rupees in 5-year fixed deposit in the name of her son, not allowed. In the name of her son, not allowed. In the name of self, it is allowed. 5-year fixed deposit in the name of self, allowed under ATC. In the name of son, not allowed. Anyways, ATC limit is already exhausted by what? PPF, so it doesn't make sense. Even if it is allowed, you cannot claim because already 1.5 lakhs is exhausted in PPF. After that, it's very simple. Compute tax as per old regime. Find out the average rate in India and then apply that average rate. Compare that average rate with 20% foreign rate and apply that on doubly tax income. Very simple. The doubly tax income will be what? The doubly tax income will be 11,97,000 is doubly tax. 6,98,000 is doubly tax. These two incomes are doubly tax. Apply the Indian average rate. What is Indian average rate? Indian average rate is this and foreign average rate is 20%. Apply that on doubly tax income. Whichever is lower will be allowed as relief. I hope it is clear to all of you. I hope it is clear to all of you. Question number 8 is a very good question, theory question. What is happening in this question? Pay attention, please, all of you. There are two countries, one country X and one country Y. With country X, we are entering into DTAA. At that time, we are discussing that whatever country X companies will invest in India, we will charge them 15% dividend on dividend tax. So, for example, if country X company invests in Indian companies, we will charge 15% dividend on in their hand. And there is a DTAA between both of us. Then we entered into DTAA with country X and country X is an OECD member. Then we entered into DTAA with country Y. There we made a promise that we will charge 10% tax. Country Y is also OECD member. Now country X people are very angry. Why? They are saying that you have entered with us DTAA first, but you are charging more what? You are charging more tax to our people. And you are entering into DTAA with country Y people later and you are charging less dividend tax to them. Why are you doing so? And we both are OECD member. So the CBDT said that don't worry, we will extend this 10% benefit to you also, provided you are OECD member. If you are OECD member, then we will extend. If you are not an OECD member, then we will not extend. So those CBDT has put some condition. The second treaty is entered into after the entry into force of the first treaty. Yes, the second treaty is entered into after first treaty. The second treaty is entered between India and a state which is an OECD member. Yes, the second treaty is also an OECD member. The first treaty is also an OECD member. India limits its rights of taxation. In second treaty in relation to the rate, yes, India will not completely exempt. India will limit its rights to 10%. And the central government will issue a separate notification for the same. Yes, central government has issued a notification for the same in 2022. Therefore, the entity is eligible for 10% tax rate. I hope it is clear to all of you. So this is what this first RTP is all about. So let's go ahead with the next RTP. RTP May 2023. Question number 1 is a very simple question. There is a partnership firm in which there are 5 partners. Now one of the partner has given a loan of 50 lakh rupees to the firm. Now if I am a firm, you are a partner. Just take an example. I am a firm, you are a partner. You are Mr. Raghav, you are a partner. I am a firm, you are giving me a loan of 50 lakh rupees. Now the firm is questioned by the assessing officer. The assessing officer is questioning firm that from where you have got this particular 50 lakh rupees. So I said that I received from the partner. So now the assessing officer is asking the partner from where you have got the money. The partner is not able to explain the source. So now if the partner is not able to explain the source, can that 50 lakh rupees be chargeable as deemed income in the hands of the firm? The answer is yes. You remember it is written in section 68 that if you take a loan from someone and if you are not able to explain the source in the hands of the person who is giving that loan, then that also is deemed income in the hands of the receiver. And it will be deemed income under section 68 unexplained cash credit, and that will be subject to 78% tax. I hope it is clear to all of you. So the person who is giving the loan, you have to explain the source in the hands of the giver also. Okay. So this is what this question is all about. Second one, you have taken some loan from a public financial institution on which there is an outstanding interest of 3.5 crore. Now you are converting that outstanding interest into a debenture. Can that be allowed as a reduction? The answer is no. If you convert an outstanding interest into a new loan or into a debenture or into a bond where the liability to pay is deferred to future date, it is not allowed as a deduction under 43B. Yes, but there is a recent judgment which I have told you in the class also. If you convert an outstanding interest into an equity share, that is allowed as a deduction. Please keep this thing in your mind. Okay. So if you convert an outstanding interest into a loan, debenture or bond, it is not allowed as a deduction. But if you convert that into an equity share, it will be allowed as a deduction. So this is what this small question is all about. Question number 3 is also very simple. There are 4 to 5 cases in which you are supposed to answer whether they are liable to file the income tax return or not, considering the situation. First assessee, Mr. Albert, whose turnover of business is more than 70 lakhs. Yes. Any person whose business turnover is more than 60 lakh rupees, you are liable to file the return. Therefore, Mr. Albert is liable to file the return. Second, Mr. Aarish is earning lot of income. First, he is earning 2.5 lakhs from profession. Then he is earning 4 lakh from interest on fixed deposit. Then he is earning another 50,000 from saving bank. Therefore, definitely his total income exceeds basic exemption limit. Therefore, Aarish is liable to file the income tax return. Third, ABC company, a law firm. I will not read ahead. A firm and company is always liable to file the income tax return, irrespective of any condition. If you are a partnership firm, LLP or a company, you are always liable to file the return. Don't read ahead. Similarly, next one, XYZ Private Limited, which has incurred an expenditure of 95,000 rupees towards electricity. It doesn't matter. A company is always liable to file the income tax return. That electricity condition is not applicable for company and firm. That is applicable for individual HUF, that electricity charges exceeds 1 lakh rupees. That is for other than company and firm. Company and firm are always liable to file the income tax return. Last but not least, Mr. Valish. Mr. Valish is depositing 50 lakh rupees in his saving bank. Is he liable to file the income tax return? Yes. If an individual HUF, etc., other than company and firm, deposit 50 lakh or more in a saving bank account, they are liable to file the income tax return. Exact 50 lakh is also covered for saving bank. For business, it is more than 60 lakh. But for investing, for depositing in saving bank, it is 50 lakh or more. Go and check the provision carefully. Very dangerous. Let's come to question number 4 now. This is a very dangerous question. Very beautiful question it is. There are multiple parts in this question. There are many small items in this question. I am trying to say all of them one by one. First of all, let me read the question. There is a cooperative society who is engaged in marketing of agricultural produce grown by its members. So if your cooperative society is engaged in this, they are eligible for ATP deduction. 100% profits are deductible. How much profit they are earning? They are earning 60 lakh profit. Apart from that, they have hired 10 employees. 10 new employees have been hired at a salary of 20,000 rupees on 1st May. Then the company, the cooperative society is getting audited under 44AB. The salary is paid by account paycheck. All these conditions are necessary. Then it also earns interest on FD of 32 lakh rupees. Now, these are the basic information which is given. Now, you are supposed to compute total income and tax liability. Don't read ahead. Now, when you are computing total income, you are supposed to compute total income as per 2 points now. First, as per the normal provision, then compute tax as per normal provision, and then compute AMT. AMT also. And always remember, in case of AMT for cooperative society, the tax rate is not 18.5%, it is 15%. So let's compute the total income as per normal provision. What will come in normal provision? First 60 lakhs will come, PGBP. Then 32 lakhs IFOS will come, interest on fixed deposit. Then 60 lakhs will be allowed as deduction fully under ATP. Then 80 JJAA will also be allowed. Why? Because you are hiring 10 employees. 20,000 emoluments, less than 25,000 rupees for 11 months. So 20,000 into 10 employees into 11 months into 30%, 80 JJAA you will claim. So you will claim two deductions. One ATP, directly ATP of that marketing from agricultural produce grown by its members. That entire amount will be deductible under ATP, and 6,60,000 will be allowed under ATJJAA. Then you will compute the tax. Normal tax for cooperative society. What is the normal tax for cooperative society? Up to 10,000, 10%. About 10,000 up to 20,000, 20%. About 20,000, 30%. Then surcharge if applicable. In this case, surcharge is not applicable because the income is less than 1 crore. This is your normal tax. Now you will compute your AMT. While computing the AMT, always remember how AMT is computed. It is nothing but total income plus profit link deduction except ATP. While computing AMT, don't add ATP. AMT is not applicable on ATP incomes. ATP deductions are not subject to AMT. Be very careful. You will not add back this 60 lakh rupees while computing AMT. Yes, you will add back this 6,60,000 while computing AMT. So while computing AMT, add back 6,60,000. Don't add 60 lakhs. You will get your adjusted total income. On that, apply 15% tax, 4% cess, and no surcharge because the adjusted total income is less than what? Is less than 1 crore. This is your first part. Second part, then check whichever is higher. Whichever is higher, that will be your tax. Now the second part of the question, advise whether it should opt for 115 BAD. Now what will happen if they opt for 115 BAD? Let's try to understand. If they opt for 115 BAD, the very first thing which will be removed is AMT. AMT not applicable for 115 BAD SSE. So 115 BAD SSE will compute how? First you will write 60 lakhs. Now I am making the changes in this solution only. First I will write 60 lakhs. Then I will write 32 lakhs. 92 lakhs is your gross total income. For 115 BAD SSE, this is allowed but this is not allowed. For 115 BAD SSE, ATP is not allowed. Only ATJJAA is allowed. So 115 BAD SSE, very straightforward. This is there. ATJJAA is allowed in 115. BAD ATP is not allowed in 115 BAD. Whatever is your total income, on that you will directly apply 22% tax because in 115 BAD the tax rate is directly 25.17. 22% tax, 10% surcharge, 4% cess, and that will come to 21,49,350 rupees. Now there is another part in this question, dangerous part. Would your answer be different if it is not a cooperative society but a cooperative bank? Yes, the answer will completely change. If it is not a cooperative society but a cooperative bank, how the answer will change? Now we will assume this to be cooperative bank. This will be 60 lakhs income, this will be 32 lakhs income. Total gross total income 92 lakhs. Now for cooperative bank, this will be allowed, this will not be allowed. Cooperative bank will not be allowed this. So for cooperative bank, what is the deduction? The deduction only ATJJAA will be allowed. ATP will not be allowed to cooperative bank. So therefore 85,40,000 will be the total income of cooperative bank as per normal provision. All three calculations you have to do once again. Then apply up to 10,000 10%, about 10,000 20%, about 20,000 30%. Then apply cess, etc. Surcharge not applicable. Now again AMT. While computing the AMT, again you will add back ATJJAA. ATP is not there only. So what you will add? ATP is not there. So you will add back ATJJAA and compute AMT. So add ATJJAA, compute AMT of 15% AMT, 4% cess. Then again 115 BAD. While computing 115 BAD, how the things will come? Assuming it is a cooperative bank, 60 lakhs will come, 32 lakhs will come. Then this is allowed in ATJJAA. So in ATJJAA, this is allowed. Therefore, the income will remain same in ATJJAA. So 85,40,000 will be the income in in 115 BAD also. Same income because ATP is not there only. Now you will compute 22% tax, 10% surcharge, 4% cess and compare the answer whichever is more beneficial. Okay. So this is what this beautiful question of what? Beautiful question of cooperative society is there. I have given you a chart of cooperative society in the class. Go and check. Okay. Next question is a total income question. Again, whenever a total income question comes, you have to check what? You have to check the last line first. What is asked? They have asked to compute total income. They have asked to compute tax liability as per 115 BAA. Okay, 115 BAA is coming again and again. Be very careful with that. 115 BAB is not very important. BAA is very important for us in the examination. SF Limited is a company engaged in manufacturing and sale of pharmaceutical products. So very first thing is they are engaged in pharma company. Their profit is 930 lakhs after debiting and crediting the following items. Now the very first item over here is the opening stock is overvalued. The opening stock is overvalued by 10%. Now the opening stock is 66 lakhs. It is overvalued. It means it is standing at 110%. Therefore, how much it is overvalued? So 10% is how much? 6 lakh. It is overvalued. So if the opening stock is overvalued, means the debit side of the P&L is overvalued. If the debit side of the P&L is overvalued, it means you have claimed more expense, so add back. You have claimed more expense, na? So add back this 6 lakh. This 6 lakhs will be added back. Similarly, the closing stock is undervalued. Now your closing stock is 63 lakhs. It is undervalued by 10%. It means it is standing at 90%. Therefore, 10% is how much? Cross multiply, it comes to 7 lakhs. So if the credit side of the P&L is undervalued, it means the profit is less. So add back the 7 lakhs. So the opening stock will also be added back. The closing stock will also be added back. I hope it is clear to all of you. Next one, you are purchasing some know-how from foreign company. Now, know-how is nothing but an intangible asset, but you are debiting that to P&L, which is wrong. Add that to P&L and claim what? 12.5% depreciation, because you are putting to use for less than 180 days. Therefore, you will not get full 25% depreciation. You can claim depreciation of 12.5%. Next one is a grandfathering clause. Grandfathering clause, you are selling some shares of a listed company, 2,97,000 is the profit. First, reduce this 2,97,000 from PGBP, and then under capital gains compute separately. But always remember, whenever 31st Jan 2018 will come in the examination, it means there is a grandfathering clause. Whenever this date only has one relevance, that is grandfathering clause for the purpose of capital gains under 112A. So how will you compute the capital gains? First step, actual cost. Actual cost means the price at which you have acquired the shares, 85 rupees. Then compare with lower of FMV on 31st January 2018, that is 195, and selling price. Lower of the two is 195. Then lower of the two will be compared with actual price. Then whichever is higher, that will become your ultimate cost. Therefore, in this case, your ultimate cost will be 195 and your sale price will be 220. The difference between them will be called as capital gains. On that will show you that you will show under capital gains, under the head capital gains. On that, 1,25,000 rupees flat exemption will be available. On the remaining amount, 12.5% tax will be available. Okay. Electricity charges of 8 lakh is unpaid. So what? Electricity charges are allowed on payment basis? No. Electricity charges are not covered in 43B. Electricity charges are on accrual basis. Therefore, this will be allowed. Even if it is unpaid, it will be allowed as a deduction. Don't worry about it. Okay. Next one. You are incurring some loss of 2.2 lakh rupees due to hedging contract in respect of import of raw material. So, you are importing some raw material. On that, you are incurring some loss. How much loss you are incurring? You are incurring loss of 2.2 lakh rupees on foreign currency fluctuation due to hedging contract. So that loss is nothing but a revenue loss, because that loss is on raw material. Therefore, that will be allowed as a deduction. It is allowed as a business loss. Next, depreciation as per books of accounts, add back. Next, dividend from foreign company. Dividend from foreign company, I have already told you, reduce from here and show under what? Income from other source. Show under income from other source. Next, 32 lakh rupees you have received from some company for entering into a non-compete contract. So whatever amount you receive in cash or in kind under an agreement for not carrying out any activity in relation to business and profession, that is for non-compete contract, that is considered to be a PGBP income. So let it be part of PGBP. There is nothing wrong in that. Next, you are receiving some advance of 22 lakh rupees. For what? You are about to sell some land, but the negotiation did not go, so you forfeited that 22 lakh rupees. So what is the treatment of this 22 lakh rupees? First of all, reduce from here and show under IFRS. Why? Because the forfeiture is happening after 1st April 2014. If the forfeiture is happening before 1st April 2014, then you will reduce from the cost of acquisition whenever you will sell it. But if the forfeiture is happening on or after 1st April 2014, then it is treated as an income from other source. Directly treat it as income from other source. Next, you are having some profit on sale of unlisted shares of 18 lakh rupees. First of all, reduce from here and show under capital gains. How capital gains, sir? Because you have purchased for 80 lakhs and you are having an excess of 18 lakh rupees. So under 18 lakh rupees will be shown as a long-term capital gains, because you purchased in 2018 and sold in 2026. Therefore, it is sold after 24 months. Therefore, it is long-term capital gains. On that, you will apply what? You will apply 12.5% tax. Next, loss of 2 lakh rupees is there on hedging contract for foreign currency payment on imported machinery from Japan. So you are importing some machinery from Japan on which you have done some hedging contract, on which there is a loss on payment. So section 43A will apply. Whatever loss is there, first of all, add back that loss to PGBP. That is not allowed. Then add that loss to what? Add that loss to machinery. Therefore, the machinery cost will become 72 lakhs. On that, claim normal depreciation of 7.5%, because the asset is used for less than 180 days. Additional depreciation not allowed, because the assessee is following 115BAA. I hope it is clear to all of you. Next, normal depreciation 35 lakhs you will claim. Then they have said that imported machinery and know-how depreciation has not been considered. Therefore, we are computing the imported machinery depreciation and know-how depreciation separately. Okay. Now, last but not least, you are hiring some 59 additional employees. 80 JJAA question. All of them are contributing in recognized provident fund. Great. It is necessary to contribute in recognized provident fund to claim 80 JJAA. But out of that, only 36 employees joined on 1st of June. On an emolument of 15,000. From that 36 employees also, it is written 10 employees salary settled by bearer check. So those will not be eligible for deduction under 80 JJAA. If you pay by bearer check, if you pay by other than 4 modes, you are not eligible for 80 JJAA. So therefore, only 26 employees will be eligible for 80 JJAA. 26 employees into how many months? 1st June, 10 months into 15,000. Emolument is less than 25,000 into 30%. But be careful with one more thing. The 10 employees whose salary is settled by bearer check, their salary should be disallowed in PGBP also as per 48.3. So disallow their salary in PGBP. because in PGBP also that expense will not be allowed. I hope it is clear to all of you. Then another 18 employees joined on 1st July, but their salary is 35,200, therefore they are not eligible for ATJJAA. Then another 5 employees joined on 1st November, their salary is 22,000, but they are not eligible for ATJJAA because they are employed for less than 240 days. In ATJJAA, the employees have to be employed for at least 240 days. After that, you are supposed to compute tax. Now, there are three taxes over here. 1112A on that 12.5% in excess of 1.25 lakhs. 1112 12.5% tax directly. And rest of the general income will be subject to 22% tax, 10% surcharge always, and 4% cess. I hope it is clear to all of you. So, this is what this beautiful question is all about. Next question is also a very good question, which is on non-resident taxation. So there is a foreign company over here by the name called as Gamma Inc. That foreign company is providing some technical services, fees for technical services to an Indian company, and there is an agreement between both of them which is approved by central government. So this is a classic case of 115A because there is no permanent establishment also in India. So if a foreign company providing what technical services to an Indian concern, there is an agreement between both of them. Agreement is approved. The services provided are FTS and there is no P115A is applicable. Flat 20% tax. 2% surcharge because the income is more than 1 crore and 4% cess. Expenses will not be allowed of 22 lakh rupees under 115A, and while filing the return they need to be careful. If they earn only this income, and their TDS is deducted as per 115A rate, not lower than 115A rate, not as per the DTAA lower rates. If the TDS is deducted as per 115A, then they are not liable to file the income tax return. I hope it is clear to all of you. Part 2. Will your answer change if that foreign company has a permanent establishment in India? Yes, the answer will drastically change. If that company has a permanent establishment in India, then 44DA will apply. In 44DA, you will take income, you will reduce expenses. 3 crore minus 22 lakhs. Again, you will take 5 crore minus 35 lakhs. But any expense which is not wholly and exclusively for Indian branch will not be allowed. Therefore, this point number 5 will not be allowed. Because this is not only and exclusively for Indian branch, therefore that will not be allowed to as a deduction. Similarly, if Indian branch is making some payment to HO other than reimbursement, then it is not allowed. If it is giving reimbursement, then it is allowed. Other than reimbursement, not allowed. Other than reimbursement, not allowed. What are the other requirements? Other requirements are this associate has to maintain books of account, they have to conduct audit, they have to file ITR, they have to pay tax as per the normal rate. 35% tax, 2% surcharge because the income is more than 1 crore or 4% cess. I hope it is clear to all of you. This question number 7. This question number 7 is a very famous question. A lot of time they have asked this question. Question number 8 is on transfer pricing. PN company is a company which is in India and Zeta Inc. is in foreign country. Now, one entity guarantees 12% of the total loans of another entity. Therefore, both of them are deemed to be associate enterprise. Why? Because as per 92A, if one enterprise guarantees at least 10% of the total loans of the other entity, then both of them are deemed to be associated. Here it is 12%. Therefore, both of them are deemed to be associated. Therefore, the transaction between both of them are international transaction. And therefore, transfer pricing is applicable. Point number 2, without prejudice to point number 1. Assume that whether point number 1 happens or not, ignore that. And then answer, if AO makes a primary adjustment of 3.1 crore rupees on 1st April and the same is accepted by the assessee, what are the conditions and the money is not repatriated to India up to 31st March and the transaction is denominated in INR. So, if the AO makes the primary adjustment of more than 1 crore rupees, then secondary adjustment is applicable if the money is not repatriated to India within 90 days from the date of order. So the AO has passed the order on 1st April 2025 and if the money is not repatriated to India within 90 days from 1st April 2025, then the AO will charge secondary adjustment because the primary adjustment is more than 1 crore rupees, it is 3.1 crore. So how the primary adjustment will be charged? 3.1 crore will be considered as deemed loan multiplied by SBI's MCLR on 1st April 2025 plus 3.25%. So 12.25% will be the rate of interest. Multiplied by 365 divided by 365. Because the loan is denominated in INR, therefore you will take SBI MCLR. If the loan is denominated in foreign currency, then we will take LIBOR. LIBOR plus 3%. 6 months LIBOR plus 3%. One more option is there. You pay one-time additional tax on 3.1 crore. How much one-time additional tax on 3.1 crore? Then secondary adjustment will stop. How much is that one-time additional tax? 18% tax, 12% surcharge, 4% cess, pay that much tax and you will be relieved from what? You will be relieved from this particular secondary adjustment after that. I hope it is clear to all of you. So this is what this paper is all about. So let's go ahead with the next RTP, that is RTP November 2023. Very first question again over here is on total income only. Associates engaged in manufacturing. Let's read the last line first of all. You are supposed to compute total income and tax liability of Mr. Manav and Mr. Manav Limited has opted for 115 BAA. So accordingly, you need to answer. The profit of the Manav Limited is 180 lakhs. Again, here there is some outstanding interest of 24 lakhs. Now they are trying to discharge that outstanding interest by issuing 8% debenture, not allowed. Conversion of outstanding interest into a new loan or into a debenture or into a bond is not allowed. But if you convert that into equity share, it is allowed as a deduction, which I have told you earlier. Then there is some income tax demand of 5,80,000 that will be disallowed. Even surcharge is disallowed. Even cess is disallowed under section 40A1. Okay, 48.2, sorry, not 48.1A. 48.2, income tax including surcharge and cess is disallowed. Then there is some provision of gratuity as per actually that is disallowed under 40A7, and whatever gratuity is actually paid, which is given in the last point, that is 105 lakhs, that will be allowed as a deduction, which you can reduce from your PGPP income. Next one is very important and controversial adjustment. Lot of students have lot of doubts in that. You are incurring some expense on foreign travel of directors. They are going to open some branch in foreign country to market their product. Always remember, it will be allowed as deduction. Why? Because if you are incurring some expense on travel of directors, foreign travel of directors, and if that expense is related to existing business, then it is allowed as deduction. But if that expense is related to new business, then it will not be allowed as deduction. In this case, it is related to existing business, therefore it is allowed as deduction. I hope it is clear to all of you. Then you are purchasing some raw material of 82,000 rupees. And you are making the payment in cash, not allowed. More than 10,000 rupees in cash, not allowed. Therefore, this 82,000 will be disallowed under 40A3. Next one, you are making a payment of 11 lakh rupees to a Japanese company whose income is chargeable to tax in India. So, if a non-resident or foreign company's income is chargeable to tax in India, you need to deduct TDS. Now, you have not deducted the TDS, therefore 100% expenditure will be disallowed in that case. Next, you are incurring some 4.6 lakh rupees on corporate social responsibility expense. Corporate social responsibility expenses are not allowed as per explanation 2 to 37.1. It is not allowed. Next one is a routine adjustment. 100% holding subsidiary, selling something to each other. Capital gains is exempt only if the recipient, that is the receiver, is an Indian company. Therefore, reduce from your PGPP and show as exempt under 47. Always remember, if the recipient is a foreign company, then it is taxable. It is exempt only if the recipient is what? Is an Indian company. Next one, you are giving some donation to what? Donation to a scientific research association, not allowed in 115 BAA. Now they are giving us 1.2 lakh is paid in net banking and balance is paid in cash. It doesn't matter. In 115 BAA it is not allowed only. So if it is not allowed, then it doesn't matter how it is paid. Okay. Next one, interim dividend is paid of 65 lakh rupees. So interim dividend will be claimed as a deduction under ATM, but the dividend will be subject to what? Dividend received. Dividend received or dividend paid, whichever is lower, will be allowed as deduction under ATM. See, always remember, in 115 BAA, you cannot claim any chapter 6A except ATM, ATLA and ATJJAA. These three deductions you can claim in what? 115 BAA. Next one is you are contributing. The employer is contributing to some pension scheme of employees, which is 15% of the salary and dearness allowance. How much is allowed? Only 14% of basic salary plus DA in terms is allowed. But you are contributing how much? 15%. Therefore, 1% you have to disallow as per section 36 subsection 1 clause 4A. Next, you are receiving some dividend from a foreign company. How much? 36 lakhs. So reduce this from PGPP and show that 36 lakhs in what? In IFOs. And compare that 36 lakhs with dividend received 36 lakhs, dividend paid 65 lakhs. Therefore, whichever is lower will be allowed as deduction under ATM. Next, you are giving some donation to a political party, not allowed under AT, not allowed under 115 BAA. Next, normal depreciation allowed, additional depreciation not allowed under 115 BAA. Next, brought forward UAD allowed because it is out of normal depreciation. If this brought forward UAD would have been from additional depreciation, even this would have not been allowed. Okay. And last one, I have already told you. There is no special income in this case. Therefore, only 22% tax, 10% surcharge and 4% cess will be imposed. No special income, no long-term capital gains, no short-term capital gains, nothing is there. So this is what this question is all about. Let's go to the next question. Next question is on TDS and TCS. There is a buyer, Delta Limited, which is a buyer, and there is a seller by the name called as Fee Limited. What are we buying? We are incorporated just this year on 1st April 2025 and we are buying coal from them. Always remember, if the seller is selling coal, then generally the seller is liable to collect TCS on coal at the rate of 1%. Coal is covered under 206C subsection 1. So the seller should collect TCS. But there is a relaxation from collecting TCS if the buyer is a resident and the buyer gives a declaration that he will use this coal for manufacturing or power generation and not for trading. In this case, the buyer is giving a declaration that he will use this coal for manufacturing and not for trading. Therefore, the seller will not collect TCS. But in that case, the buyer is liable to deduct TDS under 194Q. But in this case, even the buyer will not be liable to deduct TDS under 194Q, because for 194Q, your last year turnover should be more than 10 crore, business turnover should be more than 10 crore, and the buyer is incorporated in the current year. Now, because the buyer is incorporated in the current year, the last year business turnover is zero. Therefore, the buyer is not liable to deduct TDS also in 194Q. So again, I am saying one more part is there in this question. Again, I am saying the seller is not liable to collect TCS on coal because the buyer is giving declaration. The buyer is not liable to deduct TDS because the last year business turnover is zero. Now, the last line of this question they are saying, will your answer change if the buyer is incorporated in last year? The buyer is incorporated not in the current year but in the last year, and the last year turnover is 10 crore. Still the answer will not change, because the last year, for TDS to apply under 194Q, the last year business turnover should be more than 10 crore. Even if it is exactly 10 crore in the last year, TDS under 194Q will not apply. I hope it is clear to all of you. See how they are exactly asking the questions on margin. Exact 10 crore, if it is last year business turnover, 194Q is not applicable. Even in that case, 194Q is not applicable. Next one, let's go ahead with the next question. Sigma is a manufacturer of car and they are selling some car to car dealers. Always remember, if a manufacturer sell car to car dealer, then provisions of 2061F is not applicable. Very clearly written in the law that if a manufacturer is selling to dealer, the 2061F provisions of collection of TCS not applicable. But in that case, the buyer will be liable to deduct TDS under 194Q if the buyer's last year business turnover is more than 10 crore and the buyer purchases car of more than 50 lakh rupees. So in this case, who is the buyer? The buyer is Epsilon and Omega. Now, Epsilon's last year turnover is 14 crore. Therefore, Epsilon will be liable to deduct TDS of what? Epsilon's last year turnover is 14 crore and Epsilon is buying cars of how much? 120 lakh. Therefore, on 70 lakh rupees, Epsilon will deduct TDS at the rate of 0.1%. But Omega's last year turnover is only 9 crore. Therefore, Omega will not be liable to deduct TDS also. So, in case of Omega, neither TCS nor TDS will apply. But in case of Epsilon, TDS will be applicable on Epsilon. TCS will not be applicable because the cars are sold by manufacturer to dealers. I hope it is clear to all of you. Third question is a very simple question which I have told you in the class of British Airways Supreme Court judgment is there, Royal Dutch Airlines Supreme Court judgment is there, Singapore Airlines Supreme Court judgment which we have done in section 194H. See, the agents, air travel agents gets two type of commission. One is called a standard commission, which is a percentage, which is percentage of the price which is just a second. So there are two types of commission which are earned by the air travel agents. One is a standard commission, one is a supplementary commission. Sir, what is a standard commission? Standard commission is a commission which is a percentage of the price which is decided by ITA. International Air Transport Association, they will decide. Some percentage of that will be considered as a commission. Second is the difference between the price which is decided by the airline company and the price at which the tickets are sold. Suppose the airline company said that you should sell at 60,000. Now the air travel agent is selling for 70,000. So the 10,000 is the commission, supplementary commission. So the question over here is whether TDS under 194H will be applicable on both supplementary commission as well as the normal commission. Supplementary commission as well as the standard commission, and the answer is yes. The Supreme Court in the case of Singapore Airlines, KLM, Royal Dutch Airlines and British Airways PLC has held that the TDS under 194H will be applicable on standard commission as well as on the supplementary commission. So this is what this case law is all about. Next one, very simple question. Sir, what is there in the next question? For AY 22-23, you are filing your original return on 28th December and for declaring total income of 12 lakhs. And for AY 23-24, you are declaring a loss of 5 lakhs. They are filing the return on 30th October 2023. Now, for this second year, you want to file updated return. You already have a loss. Now you want to file an updated return by declaring income of 7 lakh. Can you file an updated return on 30th November? The answer is yes. If you have a loss of 5 lakh rupees, now you want to convert that loss into income of 7 lakh rupees, updated return can be filed. Now, by when it can be filed? If it is filed within 12 months from the end of relevant year, you have to pay 25% additional tax. After 12 months up to 24 months, 50% additional tax. After 24 months up to 36 months, 60% additional tax, Finance Act 2025 amendment. And after 24 months, after 36 months but up to 48 months, 70% additional tax, again Finance Act 2025 amendment. Therefore, in this case, because your loss is converting to income, you can file updated return. Secondly, You can file updated return when? Up to 30th November if you are filing, it means you are filing within 12 months from the end of relevant device. Therefore, you are liable for 25% additional tax. 25% additional tax you have to pay. Now, second question in this, what is the time limit for completing assessment? See, in first case, normal return is filed. In second case, updated return is filed. So, when a normal return is filed, the time limit to complete assessment is 12 months from the end of relevant device. The relevant device 22-23, 12 months from the end of 22-23 is 31st March 2024. But when an updated return is filed, it is not 12 months from the end of relevant device. Then it is 12 months from the end of the financial year in which the updated return is furnished. So the updated return is furnished on 31st of October 2023. 12 months from the end of 23-24. 12 months from the end of 23-24 will come to 31st March 2000. 12 months from the end of 30th November 2024, 12 months from the end of 24-25 will come to 31st March 2026. So in this case, the updated return will be filed till 31st March 2026. I hope it is clear to all of you. Let's go to question number 5 now. There is a search in the premise of Mr. Ajay and 160 lakhs undisclosed income is found in the search. Now, Mr. Ajay wants to set off some losses of earlier years of 90 lakhs and UAD of 30 lakhs against this income of search. Can he set off? The answer is no. Against the income which is found in search and seizure, no losses or UAD can be set off against that income. Therefore, this loss is not allowed to Mr. what? Mr. Ajay. I hope it is clear to all of you. Next question is a very simple question on DTAA. Let's try to understand this. There is an assessee aged 45 years, resident of India. Which regime we are following? We are following old regime. First, he is earning some basic salary of 62,000 rupees per month multiplied by 12. On that 50,000 standard deduction will be allowed. Then dearness allowance 10%. Then royalty income is there from country M in literary book, for literary book. Therefore, they are eligible for 80 QQB also. Royalty you can show under PGBP or IFRS. ICI has shown under IFRS. You can show under PGBP also. It's okay. 9,80,000 is the gross royalty. 98,000 is the expense. And 3 lakh rupees will be allowed as deduction under 80 QQB. Be careful. Then you are earning some rental income from country N. Then you can claim 30% standard deduction on that. Then you are earning some dividend of 2,20,000 rupees. You can show that under IFRS. Then you are purchasing some residential house property in Bhopal of 23 lakh rupees. On that 1% stamp duty you have paid. Always remember, whatever stamp duty you pay, 1% will come to 23,000 over here. That can be claimed as deduction under 80C. 80C will allow that as a deduction. I hope it is clear to all of you. Then 26,000 rupees you have paid health premium for yourself and 50,000 you have paid health premium for your non-resident what? Non-resident father. So therefore 26,000 you will get for 25,000 you will get for yourself because you are not a senior citizen, you are just 45-year-old. Therefore you will get 25,000 for yourself, and for your father also you will get only 25,000 only, even though your father is senior citizen but your father is non-resident. Therefore inflated limit of 50,000 will not be available for non-resident. It is only available for resident senior citizen. Therefore for yourself you will get 25,000 and for your father also you will get 25,000 rupees. After that you compute the tax. You compute the tax as per old regime and then find out the doubly tax income. As simple as that. While computing the doubly tax income, you need to be very careful. For doubly tax income, 1,96,000 is doubly tax income. Then your royalty is 8,82,000 is not doubly tax income. For computing doubly tax income, you have to take 8,82,000 minus 3,80,000 QQB also, and then find out the doubly tax income. That will be your doubly tax income. I hope it is clear to all of you. Question number 7. Very simple question, nothing great, but a good question. There is a foreign company from Germany who has opened a branch in India for sale of LED. Now they are selling some goods from the branch in India and some goods they are selling directly from outside India. So the officer wants, which has nothing to do with Indian branch. Some goods they are selling from branch in India, some goods they are directly selling from Germany in India, which has nothing to do with Indian branch. The officer wants to charge the goods which are directly sold to India from Germany also. Can he do so? He can do that in UN model, but he cannot do that in OECD model. Why? Because such concepts are called as force of attraction. Do you remember? Rolls-Royce example I have given you in class. If you open a branch of Rolls-Royce in India, and if you sell the Rolls-Royce through India, that is definitely taxable. But in force of attraction, if you directly also sell Rolls-Royce in India, that will also be taxable under UN model. That is called as force of attraction. But unfortunately, force of attraction is only there in UN model. It is not there in OECD model. Therefore, in OECD model, such items will not be charged. In OECD model, only the items which are sold through Indian branch, through Indian PE will be subject to tax, not something which is directly sold. Okay, I hope it is clear to all of you. So this is what this RTP is all about. Please comment below how is it going. Fast. Let's go ahead with the next RTP, that is RTP May 2024. The very first question again over here is of total income. Assessee is engaged in manufacturing and selling of pharma products. And here we have to compute lot of things. You are supposed to compute total income and tax liability in the most beneficial manner. Therefore, you have to make 3 calculations first. First, you have to compute total income and tax as per normal provision. Then you have to compute total income and tax as per 115 JB, that is book profit, etc. Then compare whichever is higher, that will be answer number 1. And then you compute total income as per 115 BAA, because they have asked us to compute as per most beneficial manner. So first, I am 3 calculations you have to make: normal provision, MAT, and then 115 BAA. First, I am computing as per normal provision. The very first thing over here is 900 lakh is your net profit. First thing is, now the things will repeat, adjustments will repeat to some extent, okay? As and when you go ahead, the adjustments have to repeat. Obviously, after doing all the 26 papers compilation, 90% of the adjustments will be repeated in the examination. Don't worry about it, okay? Now, in the month of November, you are purchasing some know-how, and this know-how is purchased in November. Therefore, add back this know-how. Know-how will be allowed as a depreciation, and you can claim 50% depreciation, that is 12.5%, because it is put to use in the month of December. It is used for less than 180 days. So you can claim 12.5% as a depreciation. Next, electricity charges are unpaid. Doesn't matter, electricity charges are allowed on accrual basis. Even if it is unpaid, it is allowed as a deduction. No worries. Next, loss of 4 lakh for purchase of raw material on foreign exchange fluctuation price. So you are importing some raw material, you are doing some hedging contract, and on that hedging contract there is some forex loss. So that forex loss is allowed as a deduction. Same adjustment has come earlier also, it is allowed as a business loss. Okay. Next, depreciation as per books of accounts will be added back. Then loss of 2 lakh for purchase of imported machinery. Again there is a forex loss. So now 43A will apply. What will you do? Same adjustment, again repeating. 2 lakh rupees you will add back to PGBP income, and then you will add back this 2 lakh to the cost of asset. You will add back this cost of asset. So therefore the machinery cost will be 65 lakhs plus 2 lakh, 67 lakhs. On that you will claim 7.5% depreciation because the machinery is used for less than 180 days, and you will also claim 10% additional depreciation because the assessee is engaged in manufacturing. And now we are computing income as per normal provision. In 115 BAA we will add back this additional depreciation. Okay, so when we will compute the 115 BAA total income, at that time we will add back this depreciation. Then 20 lakhs you are receiving as a non-compete fees for entering into a contract, for not entering into a certain business. So that is considered as a PGBP. Let it be part of PGBP. Write a note for the same. Okay. Then you have received some advance and you have forfeited that advance in respect of transfer of a capital asset. If that advance is forfeited on or after 1st April 2014, then it is considered as IFOS. Therefore, reduce from here and show under IFOS. Then there is some profit on sale of unlisted shares, 15 lakh rupees, reduce from here, show under capital gains. Those unlisted shares were acquired in 2022. Now you are selling in 2026. Therefore, it is long-term capital gains. On this, you will be liable for 12.5% tax because it is unlisted shares. Normal depreciation, 35 lakhs, you can claim depreciation. That's it. After that, you have to compute your tax. Total income you have computed. After that, you have to compute your tax. What will be the tax rate? The turnover of last year is 282 crore. Therefore, the tax rate will be 25% as per normal provision plus surcharge if applicable and cess. Okay, this will be your normal calculation. Now you will compute your book profit. Book profit will be how much? 1520 directly they have given. Book profit is 1520 lakhs. 1520 lakhs directly book profit they have given. Therefore, book profit is 15 crore 20 lakh. So how much tax you will apply on this book profit? 15 crore 20 lakh rupees into 15% tax plus 12% surcharge because the book profit is more than 10 crore plus 4% cess. Okay, I hope it is clear to all of you. Then compare normal provision or book profit, whichever is higher, that will be your answer number 1. Then you compute the tax as per 115 BAA. In 115 BAA, only one thing will be added back, and that is the additional depreciation on plant and machinery. That's it. That's the only thing which will be added back in 115 BAA. You can check it over here. Additional depreciation you will add back. That will give you your total income. In this total income, there are two incomes. One is special income. Long-term capital gains will be chargeable at 12.5%. Other income will be chargeable at normal rate of 22% tax, 10% surcharge, 4% cess. And ultimately, you check which is beneficial. Is the normal provision beneficial or is the 115 BAA beneficial? That whichever is the most beneficial, you have to give comment on that particular thing because that is the question which is asked over here. Next is a theory question, small question. The commissioner has a power to revise the order of AO under 263. Okay, so therefore the commissioner has issued some notice to the assessing officer that I want to revise your order under 143. So step number 1, the commissioner has issued notice under 263 that I will revise your order under 143.3. After that, survey has happened in place of assessees. At assessee's place, survey happened. There some new information came. Now the commissioner is issuing second notice after the survey. The content of the second notice is different from the first notice. So there is a 3-step discussion over here. Step number 1, commissioner is starting revisionary proceeding under 263. After that, survey happened at assessee's place. Now the commissioner is sending a second notice to the AO. The content of the second notice is different from the first notice. Can the commissioner do so? The court has said that no. The commissioner should stick to the decision which he has taken earlier. The commissioner should stick to the points which he has given in notice number 1. Just because the survey has happened later on, now he wants to withdraw the first notice and send a second notice, and based on that he wants to revise the order under 143.3. That cannot be done by the commissioner. Therefore, the commissioner is incorrect over here. I hope it is clear to all of you. Question number 3 is on black money law. Black money law, always remember, for understanding the black money law, the very important term of black money law is assessee. You should be assessee in black money law. There are 2-3 points which you need to keep it in mind to understand black money law. First of all, the definition of assessee. Who is an assessee? Assessee can be any of the person. A person should be resident in the current year in which you are caught. In our example 25-26, or the person should be resident in the year in which the income was taxed, income was earned, or in which the asset was acquired. You should be resident in either of the 2 years. You should be resident either today when you are caught, or you should be resident in the year in which you have earned the income or in which you have purchased the asset. If you are non-resident in both the years, then you cannot be called an assessee. Then you cannot be subject to black money law. You should be resident either today or in earlier years. Further, one more thing you need to keep it in mind with respect to black money law is that in black money law, 2 things are charged. One is foreign income, one is foreign asset. Foreign income will be charged to the year to which it pertains, but the foreign asset will be charged in the year in which it is found. So if the AO has found foreign income today and foreign asset today, foreign asset will be charged today, but foreign income will be charged in the respective year. So therefore, the black money law came in 2015-16. So if the foreign income is pertaining to earlier than 2015-16, then black money law cannot be charged. But if the foreign asset is pertaining to earlier than 2015-16, still the foreign asset can be charged, because foreign asset is not charged to respective year. Foreign asset is charged in the current year. These are the few basic things that you need to keep it in mind. Now, Mr. Rohit is an Indian citizen. He came to India in March 2014 and then he left India in March 21. Therefore, from 2014-15 to 2020-21, he was resident. Now, in the current year 25-26, he is not resident. But from 14-15 to 2021, he was resident. Now, between this period, he has purchased some shares in December 2013. December 2013 means 13-14. Was he resident in that year? No. In December 13, he was not resident. Even today, he is not resident. Therefore, he cannot be called an assessee. We cannot charge him on this particular asset. Because in 13-14 also he was non-resident, today also he is non-resident. We cannot charge this asset. Second, he has purchased some apartment in London in 2015. So in 2015, that is 15-16, he was resident, and even today he is non-resident, it doesn't matter. But in the year in which he has purchased the apartment, that time he was resident, therefore you can charge this for an asset. Third, in 21-22, he has some manufacturing factory in Malaysia for establishing leather goods. This also cannot be charged because he was not resident in 21-22. He was resident till 2021. He was resident in 2021. He was not resident in 21-22. So in 21-22 also he was not resident. Today also he is not resident. Therefore you cannot charge his income. Next, he has also earned some commission from 2014 to 2021. So commission income is chargeable in the year to which it pertains. But 14-15 you cannot charge because 14-15 black money law was not there only. Yes, commission income from 15-16 till 21-22 you can charge. From 15-16 to 21-22 you can charge the commission income because the income is chargeable in the year to which it pertains, and if the year pertains is prior to 15-16, then black money law cannot be charged. But if the asset pertains is prior to 15-16, black money law can be charged because asset is charged in the current year. I hope it is clear to all of you. So this is what this question is all about. Now question number 4, a DTAA question. Very good DTAA question. Very good. Lot of small informations are there in this question. Be very careful. First of all, you are supposed to compute total income and tax liability of Mr. Mahesh as per new regime. 115 BSc. Let's see what all things are there over here. First of all, Mahesh is 50 years old. New regime you are following. Salary 23 lakhs before standard deduction. So claim standard deduction 75,000. First of all, write salary. Next, self-occupied property. Self-occupied property, interest not allowed in 115 BAA. 115 BSc it is not allowed. In new regime, self-occupied interest is not allowed. Then, fixed deposit interest you can claim under IFRS. Income from business $25,000. How will you convert this $25,000 into rupees? You will convert this as per rule 115. What does rule 115 say? You have to take TTBR on the last day of the financial year. What is the TTBR on the last day of the financial year? It is 71. So you have to convert this as per 71. So multiply this by 71. Similarly, income from house property 4,500 minus 450. That also you will convert as per last day of the financial year TTBR as per rule 115. Then dividend income. For dividend income, rule 115 says something else. For dividend income, you have to convert dividend income into INR as per the TTBR of the last day of the preceding month in which the income is earned. The income is earned in March 26. So you have to take TTBR of 20th Feb. Therefore, on 20th Feb, the TTBR is 70 rupees. You have to multiply by 70. Same for STCG also. You have to take TTBR of the last day of the preceding month. After doing all these things, you will compute your total income and you will compute your tax. Let's see. Salary 22,25,000. House property you will take and convert. Self-occupied house property interest not allowed. Business income you will take. Short-term capital gains you will take. 1,60,000 FD interest you will take and 1,70,000 dividend income you will take. After that you will get a total income of 54,11,290. On that you will apply the slab rates. After applying the slab rates, you will also apply 10% surcharge because the income is more than 50 lakhs. Therefore, apply 10% surcharge and 4% cess. You will get your total income and tax as 13,76,000. On that 13,76,000, you will divide this by what? You will divide this by 54,11,000. Therefore, you will get average rate in India. Now, this average rate in India, you will apply on doubly taxed income in India. What is doubly taxed income in India? The doubly taxed income in India is 2,01,000 is doubly taxed, 17,75,000 is doubly taxed, 3,50,000 is doubly taxed, and 7 lakh is doubly taxed. On this, you will apply this 30,26,285. This is doubly tax. This is the tax paid in India. Now you will compare that with foreign tax. In foreign country, you are paying how much tax? You are paying 20% tax in foreign country. But be careful. In foreign country, you are not getting this municipal tax deduction. Therefore, in foreign country, you are paying 20% tax on 25,000. You are directly paying 20% tax on this 4,500. You are directly paying tax on this 10,000, and you are paying tax on this 5,000. Therefore, in foreign country, you are paying 20% tax on $44,000. If I total all these four, you will get 20% of 44,000 rupees, approximately $44,000. So on that 44,500, you will take 20%. Whatever amount will come will be your foreign tax. On that, you have to convert that into rupees now. How will you convert your foreign tax into rupees? You need to check when it is paid. It was paid by Mahesh on 25th of May. So now you will convert this foreign tax into rupees as per rule 128. See, to convert foreign income into rupees, you have to apply rule 115. But to convert foreign tax into rupees, you have to apply rule 128. And what does rule 128 say? You have to convert as per TTBR on the last day of the preceding month in which the tax is paid. The tax is paid on 25th May. So the last day of the preceding month is 72. So now you will multiply this entire tax. 44,500 is your total income in foreign country. 20% is the total tax in foreign country. Multiply by 72. That will give you your tax paid in foreign country. So the tax paid in India is 769. Tax paid in foreign country is 640. Therefore, whichever is lower will be allowed as a relief. And the balance amount you have to pay from your pocket. I hope it is clear to all of you. Let's move on to the next question. Question number 5. What is this question, sir? This question is on rollback provision. Do you know that you can make an application for APA for future 5 years and rollback for past 4 years? So you have made an application for what? Rollback on 50, application for APA on what? 15th of February 2025. So on 15th of February 2025, you are making an application which was signed on 5th of May 2025. Now you have been asked a question that can you roll back the agreement for the past years? So for first year 2020-21 you cannot roll back because you can roll back only for 4 years and 2020-21 is beyond 4 years. Even for 21-22 you cannot roll back because you can roll back only for 4 years, not beyond 4 years. Yes, for 22-23 you can definitely roll back. There is no dispute and assessment have been completed. Even if the assessment has been completed, you can roll back. There is no condition that if the assessment is completed you cannot roll back. There is no condition like that. Now the next one, in next year 23-24 the TPO has enhanced your income by 500 lakhs. See, one of the conditions that you cannot roll back is if your income falls below what the income declared in the ROI. So whatever is the income declared in ROI, because of rollback your income cannot go below that. So if I have told you in the class also, suppose in your ROI the income is 100 lakhs and if the TPO increases to 120 lakhs and after rollback it becomes 90 lakhs, then you cannot go for rollback. Your rollback cannot reduce your income below ROI. But yes, if you accept that I am ready to declare 100 lakhs as my income, then you can roll back. In this case also, the TPO has increased by 500 lakhs. The income can reduce below 500 lakhs also, but it should not reduce below what? The income which is declared in the ROI for AY 23-24. Similarly, for 24-25, can I go for rollback? Let's check what has happened. The matter has been to tribunal. The matter has been to tribunal for 24-25 and tribunal has set aside the case for fresh consideration by the AO. Yes, you can go. Remember, if the tribunal has already passed an order discharging the matter at its end by confirming the order, by annulling the order or by modifying the order, then you cannot go for rollback. If the tribunal has closed the matter, then you cannot go for rollback. But if the tribunal has remanded back the case to AO, then you can definitely go for rollback in this case also. And for last year, you cannot go for rollback because you have filed the return late. One of the conditions for going rollback is you should file the return on time. If you file the return late for earlier years under 139(4), then you cannot go for rollback. I hope it is clear to all of you. So this is what this question is all about. And this is what this RTP is all about. Let's move on to next RTP, RTP November 2024. Now what is given in this RTP? Again, a total income question has to be computed in the most optimum income tax liability. Again, you have to compute as per normal provision, then as per MAT and then as per 115BAA, just like the previous RTP. Okay. So let's start with the question. The very first item which is given over here, associate is engaging manufacturing of pharma product. This is very important line. The pharma product is very important line. Some adjustments are related to pharma over here, which is given in this question. First thing which you are doing, you are incurring 6 lakh rupees as a public issue expenses that will not be allowed as reduction. Any expense incurred for issuing shares not allowed, even though the public issue could not be materialized due to non-clearance by SEBI. It doesn't matter. Any expense which is incurred with respect to what public issue, share issue, it's a capital expenditure. Therefore, it is not allowed as a reduction. Be very careful. Okay. The next adjustment is also a new adjustment. You are purchasing some goods of 5 lakh rupees from a micro enterprise Sunny Traders on 25th of February 2026, and you have made a commitment that I will make the payment in 25 days. So if you purchase anything from micro or small enterprise, and if you make a commitment that I will make the payment in 25 days, if you make the payment within time, then the expenditure will be allowed on accrual basis. But if you make the payment beyond time, then the expenditure will be allowed on payment basis. Now, if you make a commitment that I will make the payment in 25 days, now you are making the payment on 29th March 2026, which is beyond 25 days. So you will be allowed the deduction on payment basis, not on accrual basis, because you are not making the payment on time, you are making the payment late. But even though you are making the payment late, still the payment is made in the same financial year. Therefore, no need to worry, you will get the deduction in the current year itself. Yes, if this 29th March would have been 3rd April, then you would have been given the deduction in the next year 26-27. Now, because this 29th March is also in the same financial year, you can claim the deduction in the current year, no issues. Okay. Third one, you are a pharma company, you are giving freebie to medical practitioners, not allowed. Pharma company giving freebies to doctors, medical practitioners, medical associations, not allowed as deduction. Next one, it is disallowed under explanation to section 37(1). Depreciation as per books of accounts, disallowed. One-time license fee you are paying for obtaining a franchise, then that is disallowed, and on that you can claim 25% additional depreciation later on. Okay. Next one, you are setting up some warehouse in rural area for storage of agriculture produce. Now this is eligible for 3580 deduction. Now on that there is a profit of 17 lakh rupees. So do one thing, show this profit separately. Don't merge this profit with your pharma business. So reduce from here and show under PGBP separately. Next one, you are receiving some power subsidy that is considered as a revenue income. Therefore, let it be part of income. Write a note that power subsidy is an income as per section 2, clause 24, subclause 18. It is deemed to be income under section 224(18). Next one is your again grandfathering clause. I am irritated with this grandfathering clause. Again and again it will come. 4,80,000 is your profit. Whenever 31st Jan 2018 will come, it means it is a grandfathering clause. 4,80,000 is your profit from shares on which STT is paid. So that profit you will reduce from PGBP, and under capital gains you will compute separately whatever capital gains will come. How will you compute? You will compute the cost separately. Cost will be actual cost compared with lower of FMV on 31st Jan 2018 or share or selling price, whichever is lower. Compare that with actual cost and then whichever is higher. That will be your cost. Okay. Now next one is also a very, very intelligent adjustment. Now one thing you need to remember in point number H, whatever capital gains will come, on that 12.5% tax will be imposed. In excess of what? In excess of 1,25,000 rupees, because it is covered in 112A. Next, you have taken a loan from Punjab National Bank of 8 lakh rupees. Now that loan is taken for working capital requirement, and that loan is waived off by the bank. In that there are two parts. 6 lakh is your what? Is your principal, and 2 lakh rupees is your interest. So whatever principal is waived, now entire 8 lakh rupees you have credited to what? P&L account. Now that on that principal which is waived, that is considered to be your income. Why? Because it is remission and cessation of a trading liability. Therefore, that principal will be subject to tax. What about interest? Interest will not be subject to tax. Why? Because interest as an expense was not allowed as deduction because of 43B. Because as per 43B, if you take a loan from PNB, interest is allowed on payment basis. Because the interest was disallowed earlier, therefore again on waiver of interest, it cannot be subject to tax. Therefore, reduce interest what? From your PGBP income and let principal be part of your income. Principal will be subject to tax. Next one is you are employing 50 employees in the financial year 25-26 on a regular basis. They participate in the recognized provident fund. Then emolument is also less than 25,000 rupees. You are employing them for also more than 240 days. Therefore, you will be eligible for what? You are also making the payment by account paycheck. Therefore, you will be eligible for 80 JJAA year. 50 employees into 23,000 into 9 months, because from July into 30%, 80 JJAA deduction will be available. Next, for warehouse of agriculture, for warehouse of sugar, you have invested 40 lakh rupees. Out of that, 25 lakh is land. Therefore, 15 lakh rupees will be allowed as deduction under 3580. So, under 3580, what will be your income? You have already shown 17 lakh as a profit. From that, 15 lakh rupees you will claim as a deduction. Therefore, 2 lakh rupees will be taxable profit under 3580. Last but not least, your depreciation as per income tax law is how much? 9,20,000. You can claim that as deduction. Your turnover of last year is 395 crores, which is less than 400 crore. Therefore, 25% tax will apply, surcharge if applicable, and cess. Now you will compute tax as per what? Tax as per book profit. 115 JB, 99.5 lakhs is your book profit. Therefore, 15% tax and 4% cess. No surcharge because income does not exceed 1 crore rupees. Now you will compute optimum tax. For that you will compute 115BAA. What is different in 115BAA and normal provision? Only one thing. Whatever 3580 deduction you have claimed 15 lakh rupees, you will add back that 15 lakh rupees, and on that 15 lakh rupees, that is a building, on that 15 lakh rupees you will claim what? Normal depreciation of 10%. That's the only thing which is different under 115BAA and normal provision. So in 115BAA, what are you going to do? Add back the depreciation, add back the 3580 deduction of 15 lakh, and on that you will claim your normal depreciation of building of 10%. Okay. After that you apply on special income, you apply special rate. On normal income you apply 22% tax, 10% surcharge, 4% cess, and whichever is more beneficial, go for that. If normal provision is beneficial, go for that. If 115BAA is beneficial, go for that. Whichever you are comfortable, you go for that. Okay. I hope it is clear to all of you. Now question number 2. Question number 2 is one of the best questions that I have come across till now. I am not saying in the entire 26 paper. There are much better questions which will come later on. But question number 2 is one of the best questions that we have come across so far. It's a question on partnership firm XYZ and company. There are 3 partners, A, B, C, who are working partner, and there is one non-working partner. So total there are 4 partners, and their details are given, and you are supposed to compute two answers. First, the firm do not want to get its books of accounts audited. Advise the firm on its total income. Firm does not want to get the books of accounts audited. You want to compute the total income of the firm. How will you compute the total income of the firm? See, audit is not required. They don't want to do audit. Now the turnover of the firm is 2 crore 80 lakhs. Be careful. Can the firm go for 4480? Yes, they can go. Generally, if your turnover is more than 2 crore but up to 3 crore, you can go for 4480 only if your cash receipt is up to 5% of your total turnover. So if your cash receipt is up to 5% of your total turnover, you can go for 4480. Let's check the cash receipt and the total turnover. If it is within 5% range, they can go for 4480, and if they can go for 4480, there is no audit required. So therefore, what is the cash receipt? The cash receipt is 2 lakh over here. 2 lakh is cash receipt, and this 10 lakh 50,000 is also cash receipt. This is cash receipt directly, point number 3. And point number 4, receipt by way of a check other than account paycheck. If you receive by other than account paycheck, that is also considered as cash only for the purpose of 4480. Go and check. It is written in 4480. Any amount received other than account paycheck will be considered as cash. So total cash receipt is 12.5 lakhs. And what is your total turnover? 280 lakhs. This is 4.46%. Therefore, you are well within the range of 5%. Therefore, you can go for 4480. Therefore, audit not required. Now, compute income as per 4480. On cash portion, 8% deemed income, and on other than cash portion, 6% deemed income. From that, you can claim brought forward business losses. In 4480, you cannot claim any deductions from 28 to 44, but you can definitely claim losses. Therefore, from this amount of 4480 income, you cannot claim remuneration interest paid to partners. That is not allowed. 40B is not allowed from 4480. But yes, business losses are allowed from 4480. After that, you have to show one thing extra, that is capital gains. 57 lakh is the sale of land, and 12 lakh is the acquisition of the land, cost of acquisition, which has been purchased 5 years back. Indexation not available after 23rd July 2024. Therefore, 57 lakhs minus 12 lakhs, 45 lakhs will be your capital gains, and this 45 lakhs is your capital gains, and this is your PGBP income. This is your part 1. Check it, please. This is your PGBP income. From that, 75,000 business loss is set off and 45,000 rupees capital gains. From that GTI will come. Okay, this is your part 1. Now part 2, very intelligent. Again compute total income, assuming that instead of 2 lakh received from firm, 4 lakh is received by check other than account pay check. Let's assume that this is not 2 lakh, this is 4 lakh. So now if this is not 2 lakh, this is 4 lakh, therefore total cash receipt is 14.4 lakhs. So if the total cash receipt is 14.4 lakh, now if you do 14.4 lakh divided by 280, it is going beyond 5%. Now because it is going beyond 5%, now you cannot claim 44AD. 44AD cannot be claimed. Now you have to compute total income as per the normal provision. You have to compute total income as per the normal provision. So start computing total income as per normal provision. The net profit is 8,65,000 after debiting and crediting the following items. The first item that you are going to add back, net profit 8,65,000. Now 4480 not available because your cash receipt is more than 5%. So 8,65,000 is your net profit. Interest 15% not allowed. Add 3% back first. Item number 1 to add back is interest. Then 60,000 remuneration you are paying to all the partners. So there are 4 partners, to all of them you are paying remuneration. Add back entire remuneration. 60,000 into 4 partners into 12 months. Add back the entire remuneration. Then what else to add back, sir? Third item, you have to reduce the profit. Profit you have credited to P&L. Capital gains you have credited to P&L. So reduce that 45 lakhs from P&L account. Then, sir, one more item. You are making some payment of 12,000 rupees cash payment to a clerk which is debited to P&L. Rest all does not exceed 10,000, but clerk payment is exceeding 10,000. So 12,000 into 12 will come to 1,44,000. So 4 adjustments you are supposed to make. Which 4 adjustments? The interest you have to add back 3%. Remuneration you have to add back all 4 partners. Clerk salary you have to add back 144, and then you have to reduce your capital gains of 45 lakhs. After that, there is a book loss. There is a book loss. So if there is a book loss, not book profit, then how much remuneration you can claim as a deduction? Maximum 3 lakh rupees, not more than that. So your maximum limit is 3 lakh, but your actual remuneration is 21 lakh 60,000. How, sir? For 3 working partners, 60,000 into 12 into 3 working partner, actual remuneration 21 lakh. But in case of loss, you cannot claim more than 3 lakh. Therefore, 3 lakh you can claim as a loss. Therefore, ultimately your business loss will come to 881. Already 581 is your loss and 3 lakh more loss because of the remuneration. 881 is your loss. Now you can set off this loss against your capital gains income. Yes, you can set off. PGBP loss can set off against capital gains income, but capital gain loss cannot set off against PGBP income. PGBP loss you can definitely set off against capital gains income. Sir, what about last year 75,000 loss? That you cannot set off against capital. That you cannot set off against capital gains income, because last year business loss can set off only against current year business income. But current year business loss can set off against any other loss, any other income except salary. Last year business loss cannot be set off against current year capital gains income. Last year business loss can set off only against current year's PGBP income. And in current year there is no PGBP, there is already a loss. Therefore that 75,000 you have to carry forward. I hope it is clear to all of you. Question number 3 is a very simple case law question. There is a telecom company and you are a distributor. And I am giving you SIM card, I am giving you recharge coupons, and I am selling you SIM card and recharge coupon. There is no principal-agent relationship. There is a principal-principal relationship. So if there is a principal-principal relationship, 194H will not apply. If there is a principal-agent relationship, then 194H will apply. That is what it is mentioned in this particular question. Check it, please. Question number 4. Again, a very simple question. The assessing officer is doing a survey in the night at 9:30 p.m. in a sports complex. The sports complex is open between 5 a.m. to 10 p.m. So the first question is, can he enter in the night? See, there is a provision in the survey section in 133A that the assessing officer can enter for survey provided he has taken an approval from higher authority like Principal Director General, Principal Chief Commissioner and Commissioner. Let's assume that he has taken the approval. The question does not specify about approval. Let's assume that he has taken an approval. Let's assume that he has taken an approval, and approval is not a concern. Now let's talk about the timing. Can he enter after sunset? There is a provision in survey section that the officer can enter only after sunrise but before sunset. But there is further a provision that if the business hours is in night, then he can enter in the night also. What is the business hours? The business hours is from 5 a.m. to 10 p.m. and he is exactly entering half an hour before the business hours end. Therefore, he can enter. There is nothing wrong in that. Second thing, can he after entering take away books of accounts and cash? Books of accounts and cash. So there are 2 things which he wants to take away. One is cash, one is books of account. Let me talk about cash. Cash he cannot take away. In case of survey, he cannot take away cash under any circumstance. Yes, for books of account, he can take away the books of account for as much time as he wants For as much time as he wants, he can take the books of account. But if he wants to take the books of account for more than 15 days, excluding holidays, then he has to take approval from higher authority. Cash he cannot take. Books of accounts he can take up to 15 days. No worry, beyond 15 days he can take an approval and take beyond 15 days also. Okay. Next question, question number 5. A very simple question. Penalty. There is an investment fund under 9A. Sir, what is investment fund? We have done in the chapter of non-resident taxation. Then hopeless section is there. There is an investment fund outside India. There is a fund manager in India. They have to fulfill 17 conditions. 13 conditions should be fulfilled by the fund. 4 condition has to be fulfilled by the manager. Then the income of the investment fund will be not subject to tax. So who will check whether these conditions are fulfilled or not? For that purpose, investment fund has to file a statement in form 3CK within 90 days from the end of the financial year. So they have to file a statement in form 3CK by 29th of June 2026. If they don't file a statement under form 3CK, then they will be liable for penalty of 5 lakh rupees under 271 FAB. That is what it is mentioned over here. So what is the penalty for not filing the statement within 90 days? It is 5 lakh rupees under 271 FAB. I hope it is clear. Second question over here is also very simple. There is a caterer who is receiving 1 lakh in cash and 9 lakh account pay check, so no issues. Because you are receiving only 1 lakh in cash, if you receive 2 lakh or more in cash, then the provision of 269 ST will apply, 271 D apply. Because here you are receiving only 1 lakh in cash and 9 lakh by account pay check, no penalty will be imposed under 271 DA in your hands and no 269 ST will attract in your case. I hope it is clear to all of you. Question number 6, very dangerous question. Very dangerous question. This is the best question on DTAA across the book. Best. No DTAA question can be better than this. First of all, Mr. Rakesh or Mr. Ram Prakash, whomsoever it is a resident. You need to compute the income as per and tax liability as per new regime 115 BSE. And Mr. Rakesh and Mr. Ram Prakash, whomsoever it is, he is earning income from 3 countries, country X, country Y and India. Let's compute total income in India. When you compute total income in India, you will take house property 2 lakh 50, 2 lakh 50, 5 lakh minus 30% standard deduction. Then all these losses will be set off against all this PCPP income of 2 lakh 80, 3 lakh 40 and 1 lakh 80. 10 lakh 80,000 STCG will go in short-term capital gains. 37 lakh long-term capital gains on sale of house. And to save that long-term capital gains, you have purchased another house within 1 year, that within 2 years in the name of your spouse, joint name with your spouse. Can you purchase a new house in the name of your spouse? Yes, why not? The Delhi High Court in the case of Kamal Wahal has held that you can purchase another house, another residential house in the name of your wife. Your wife is not a stranger. You can purchase. So far as the consideration is invested by the SSC, you can claim. Then 3,40,000 agriculture income will be taxable in India. Foreign agriculture income is not exempt. Indian agriculture income is exempt. 1,80,000 agriculture income from country Y is also taxable. Yes, 5,20,000 agriculture income will not be taxable in India. So everything will come in the total income except this Indian agriculture income. Everything will come in the income. And from gross to from rental income, you will claim 30% standard deduction. I hope it is clear to all of you. After doing all this thing, you will get your total income. Total income 37 lakh. Now you have to compute tax. How will you compute tax? Don't compute tax directly on 37 lakhs. You are gone. There is an agriculture income. You have to apply partial integration. Step number 1, compute tax on 37 lakh plus agriculture income. So compute tax on what? 42.2 lakhs. Step number 1, compute tax on agriculture income and total income. Compute tax on 42.2 lakhs. Now while computing the tax on 42.2 lakhs, be very careful. Out of this 42.2 lakhs, 12 lakhs is long-term capital gains. Therefore on long-term capital gains, compute 12.5% and on other income, compute as per slab rates. That is your step number 1. Step number 2, compute tax on agriculture income plus basic exemption limit. Agriculture income is 5.2 lakhs, basic exemption limit is 4 lakhs. Now compute tax on 9.2 lakhs. This is your step number 2. Now step number 1 and 2, difference, take the difference between step number 1 and 2. Step number 1 minus step number 2 will be your ultimate tax. On that apply cess. No surcharge because the total income is less than 50 lakhs. Apply cess and then you will get your tax. And then you will divide this by 37 lakhs and therefore you will get your average rate in India. The average rate in India is 16.98. Now compare this average rate in India with foreign average rate. Now in country Y the average rate is 27%. But in country X the average rate is not given. They have given the slab rate. So for country X we need to first of all find out the average rate. How will we find out the average rate in country X? For country X we need to find out the average rate by taking country X total income in the denominator and then computing tax as per the slab rates and taking that tax in the numerator. So what is country X total income? Let's try to understand what is country X total income. Try to understand please. Pay attention please. Sir, will this 2,50,000 come in country X total income? Yes, 2,50,000 will come in country X total income. In country X you will not get any 30% standard deduction. Sir, will I reduce this 1,20,000? No. In country X this loss is not allowed. Check. not in country X. Loss from cannot be set off in country X, therefore in country X do not set off. Sir, will I take business income? Yes, take business income in country X. Sir, STCG, yes, take STCG in country X. And sir, agriculture income is exempt in country X, so don't take country X agriculture income. In country X, you don't pay tax on agriculture income. Therefore, country X only 3 income will come: 2.5 lakhs, 2.8 lakhs, 10.8 lakhs. This is your denominator. On this denominator, apply this slab rate. You will get the tax. After you get the tax, you will get the average rate. Now that average rate you will compare with Indian rate. And now you will compare the average rate, whichever is lower, and now you will apply that on doubly taxed income. Sir, what is doubly taxed income in case of country X? In case of country X, doubly taxed income is not 2,50,000, it is 2,50,000 minus 30%. Then, in case of country X, doubly taxed income is this 2,80,000, this 10,80,000, this is not doubly taxed income, and this 1,20,000 rupees you have to reduce, because on that 1,20,000 you are not paying tax in India. Similarly, doubly taxed income you have compute in the same manner the way you have been computing earlier also. 2,50,000 minus 30% is doubly taxed income, then 1,30,000, then this. And in country Y, agriculture income is taxable. Therefore, in country Y, this 1,80,000 is also what? Is doubly taxed income. Country X only agriculture income is exempt. In country Y, it is taxable. Therefore, in country Y, this 1,80,000 is also doubly taxed income. Very, very great question. No question can be better than this in the entire 26 paper. They cannot ask you such question, such big question in the same manner. They have to reduce the content and then ask. Such a big question, if they start asking in the examination, students will go mad. They cannot ask such big question in the examination. It is very, very, very big. Next question. Question number 7, which is on poem. There is a foreign company which is located in USA. Their global assets are 50 crores and their Indian assets are 25 crores. Now, if they pass ABOI test, then their poem is outside India. But the first condition of ABOI test is what? The second condition of ABOI test is failed. What is the second condition of ABOI test? The Indian asset should be less than 50% of total asset. Now, Indian assets are exactly 50% of total asset. Therefore, ABOI test is failed. Further, one more condition is there, that there are 10 board meetings are held, out of which only 4 are held in India. But major commercial decisions are made in India only. Now, this is sufficient evidence. They are failing the ABOI test and majority of the big decisions are taken in India. Therefore, poem is in India. Therefore, this foreign company is a foreign company, but at the same time, it is resident also. It is a foreign company as well as it is a resident. Now I am making a professional fees payment to this foreign company. I am making, say, 10 lakh rupees professional fees payment to this foreign company, which is a foreign company as well as resident. So now I will deduct TDS as per what? 194J or 195? Because in 194J it is written, if you make the payment to resident, then you should deduct TDS. Yes, this is a resident company. Then 195 it is written. If you make a payment to foreign company, you should deduct TDS. Yes, it is a foreign company also. So if there is a clash between resident and foreign company, for the purpose of TDS, what should I consider? So the CBDT has given a circular that if there is a clash between 194J and 195, if there is a clash between resident and foreign company for the purpose of TDS, consider this as a foreign company and tell them to fulfill all the related requirements also, like you have to deduct TDS as per 195 and also you have to fill form 15CA, 15CB, all the related formalities also you have to fulfill. I hope it is clear to all of you. Next question. It's a very simple question. There is an Indian company which is located in SEZ, in which a foreign company holds 30% share, therefore both of them are deemed to be associate enterprise. Now you have to compute the arm's length price in 3 different transactions. Now you are selling 90,000 pieces at rupees 10 to your associate enterprise. To third party you are selling at 12 rupees. So to associate enterprise you are selling at lower price. To third party you are selling at higher price. Therefore how much higher? $2 higher. So 90,000 pieces into $2 into 85 rupees. That will be your addition in the arm's length price. Second, you are paying some guarantee fee of 15,000 rupees to associate enterprise. To third party you are paying only 12,000. Therefore 3,000 extra you are paying. So $3,000 into 85 rupees will be your increase in arm's length price. Third one, you are taking some details of potential customers and you are paying 18,000 rupees to your associate enterprise. To third party you are paying only $16,000. So $2,000 extra you are paying to your associate enterprise. Therefore that $2,000 will be added to your arm's length price. $2,000 into 85 rupees will be added back. So these are the adjustments which will be made as per point number 1. Point number 2 says that if such adjustments are made by AO, can you claim deduction under 10AA on the enhanced income? No. If the AO increases the arm's length price, then as per 92C subsection 4 first proviso, the AO increases the arm's length price, then you cannot claim profit link deduction, you cannot claim chapter 6A on that income, and you cannot claim 10AA on that particular income. So this is what this particular paper is all about. So let's go ahead with the next RTP, that is RTP May 2025. Now the very first question over here is on total income question. The assessee is a domestic company. The profit of the assessee is how much? The profit of the assessee is 1 crore 7 lakh rupees. Now, I have already told you that whenever a question on total income comes, you need to always see the last line, what they are exactly asking. So they are asking us to compute the total income and tax liability as per 115BAA. So as per 115BAA, you are supposed to compute the total income as well as the tax liability. So let's start computing the total income and tax liability as per 115BAA. The profit is 1 crore 7 lakh. The very first thing which is given over here is the credit to the PNL, and then they have given the debit to the PNL. Let's talk about the credit to the PNL first. The first item which is credited to the PNL is rent received from vacant land. Always remember, when you receive any rent from a vacant land, that goes under IFOS, it is not income from house property. If you want to classify an income as an income from house property, there has to be a building or land upper tenant to the building. A vacant land will go under income from other source. Therefore, reduce from here and show under what? Show under income from other source. I hope it is clear to all of you. Second one, you are earning some rent from commercial property of 5,30,000. The tenant has deducted 10% TDS. Okay. So now this rent will go under income from house property because this is from building. This is from a commercial property. You will reduce this rent from here and you will show this rent under income from house property. From that you will claim 30% standard deduction. Now the question will come to some of your mind that whether we get deduction of 30% standard deduction in 115BAA. The answer is yes. In 115BAA, 30% standard deduction is allowed. In 115BAB, it is not allowed. In 115BAB, the rent is directly taxable. But in 115BAA, you get the deduction of standard deduction and municipal tax also. I hope it is clear to all of you. Next one, you have got some income tax refund. On that, there is some interest. So what is the treatment of interest on income tax refund? It goes under income from other source. Reduce from here and show under income from other source. Next one, you have sold some plot of land for, and the profit on the sale of land is 8 lakh rupees. So first of all, do one thing, reduce this profit from what? PGBP, and show this profit under capital gain. So how to compute this profit? So for that purpose, they have given some information in the point number 6 in the additional information. You can check it over here. The plot was purchased in Jan 24 and it is sold in March 26. The plot was purchased for 50 lakhs and it is sold for 58 lakhs. Therefore, the capital gains will be considered to be long-term capital gains. So how it will be considered? Long-term, because it is sold for after 24 months. Therefore, this 8 lakh rupees will be long-term capital gains. So what is the ultimate treatment? Reduce from PGBP, show under capital gains. Under capital gains, you have to show 12.5% as your tax. I hope it is clear to all of you. Next, you are receiving some dividend from foreign company of 6 lakh rupees. So the very first thing you will do is reduce from PGBP, show under IFOS. But at the same time, to invest in this foreign company, you have taken a loan. Check here in point number 8. You have taken a loan. On that loan, you have incurred an interest of 1,50,000 rupees. So do remember that against the dividend income, do you get any deduction? Yes. Against dividend income under IFOS, we get only one deduction, that is interest expense. That to up to 20% of the dividend. Now, what is the treatment? You are paying 1,50,000 as interest. Okay, but your dividend is only how much? 6 lakh rupees. What is 20% of 6 lakhs? You will get only 20% of 6 lakh as deduction from IFOS. That is 1,20,000 rupees you can claim. So what is the treatment? Add back 1,50,000 in PGBP and in IFOS claim 1,20,000 as deduction, because only 20% will be allowed as deduction. Again, I am saying this 1,50,000 add back in PGBP and claim 1,20,000 as deduction under IFOS from 6 lakh rupees. Therefore, your net dividend will be how much? The net dividend will be 4.8 lakh rupees. I hope it is clear to all of you. Next one is depreciation. Add back depreciation as per books of accounts. Then next is donation you have given for Swachh Bharat Abhiyan. That is ATG, but ATG is not allowed in 115BAA. Therefore, add back this ATG deduction also. Next is you are contributing some pension for your employees. Now, if an employer contributes pension for employees, is the employer eligible for deduction? The answer is yes. How much? 14% of basic salary plus DA in terms. 14% of basic salary plus dearness allowance in terms. Now, what is the basic salary in dearness allowance in terms? That is given in point number 7 below. It is 10 lakh rupees. The basic salary and dearness allowance is 10 lakh. Therefore, 14% of that is how much? 1,40,000 will be allowed as deduction. But you are contributing how much? You are contributing 1,90,000. Therefore, how much deduction will be allowed to you? Only 1,40,000 will be allowed to you. Therefore, 50,000 expenditure will be disallowed over here. Next, you are making some payment of 60,000 rupees to a road transporter. Now, generally, if you make a payment to a road transporter, you are supposed to deduct TDS under 194C. But there is a relaxation that if the road transporter does not own more than 10 goods carriage at any time during the previous year, and he gives a declaration that he does not own more than 10 goods carriage, and he gives a pen, then I am not supposed to deduct TDS. All those things are happening here. He is following 44AE. He does not own more than 10 goods carriage. He is giving a pen. He is giving a declaration. Therefore, there is no need to deduct TDS. And even if you have not deducted the TDS, the expenditure will be fully allowed to you. Don't worry. Next, bonus of 4,48,000 is debited to PNL. Now, we all know that bonus to employees are allowed on payment basis. As per 43B, you should pay till the due date of filing of return. Now, when have you paid? You have paid after the due date of filing of return on 18 December. Therefore, this bonus will be disallowed under the income tax law. Next is income tax. Income tax is disallowed. The interest of income tax is also disallowed under section 48(2). Both of them are disallowed. Next is you are giving some donation to a university which is approved under 35(1)(2). That is Scientific Research Association. Therefore, that is not allowed in 115BAA, therefore disallow that. This donation to Scientific Research Association is disallowed under PGBP under 115BAA. Under normal provision it is allowed, under 115BAA it is not allowed. Just comment below and let me know whether the voice is properly coming or not. Please, somebody is saying that voice is not coming. So if there is an issue, let me know. Okay. Next one, depreciation of 18 lakh rupees as per Income Tax Act is there. So you can claim the deduction because this information is given in additional information. You have to separately compute. Now, some mistakes they have done. Let's see whether that is a mistake or not. Now, on printer and scanner and EPBX, they have claimed 40% depreciation. Whether printer and scanner are eligible for 40% depreciation, the answer is yes. Printer and scanner are considered to be peripheral of computer. Computer and its peripherals both are subject to 40% depreciation. Therefore, printer and scanner 40% is okay, but EPBX 40% is not okay. On EPABX, only 15% depreciation is allowed. Therefore, you have to add back 25% depreciation over here and disallow 25% depreciation. Printer and scanner 40% is okay. EPABX 40% is not okay. There 25% you have to add back. Next one, additional depreciation you have not considered. Good enough, you have not considered additional depreciation because in 115BAA additional depreciation is not allowed only. Therefore, it is better that you have not considered what? Additional depreciation. I hope it is clear to all of you. Next one, you have done some provision for audit fee in the last year of 1 lakh rupees without deducting TDS. So in the last year you have made one journal entry and you have not deducted the TDS. So in last year 30% of the audit fees would have been disallowed, but in the current year you have deducted the TDS and you have paid the TDS. Therefore, in the current year you should get the deduction of that payment of TDS. Therefore, in the current year you can claim 30% deduction. Very simple. Last year 1 lakh rupees you have not deducted the TDS. Therefore, last year 30% of 1 lakh would have been disallowed, but in the current year you have paid the TDS. Therefore, 30% of 1 lakh will be allowed to you in the current year. Similarly, last year there was an outstanding expense of 90,000 rupees on which you have claimed the deduction for purchase of raw material. You would have purchased some raw material by passing journal entry. Purchase account debit to creditors account 90,000 rupees. Now in the current year you are making the payment by cash. 45,000 you have paid by cash. That is wrong. So if you claim deduction of an expense on accrual basis in 1 year, and in the next year if you make the payment by other than account pay check, account pay draft, ECS and such other electronic mode, in the next year it will be added to your income and it will be called as deemed income. I hope it is clear to all of you. Next adjustment is of no use to us. Earlier it was relevant, now it is not relevant. You are issuing some shares of 1 lakh rupees at rupees 90, whereas the fair market value is 60 rupees. Before 2024, there was a concept of angel taxation. At that time, it was relevant. Now it is not relevant. So ignore that. Okay. Now, apart from this, one last adjustment is there. Point number 8. You are declaring an interim dividend of 5,20,000 rupees in September. So it is good that you are declaring the dividend 1 month prior to the due date of filing of return. Therefore, you can get the deduction under ATM. ATM you can get the deduction, but how much? Dividend received minus dividend paid, whichever is lower. So dividend received is how much? 4.8 lakhs. I have already told 6 lakhs minus 1,20,000 interest expense. 4.8 lakhs is the dividend income. And how much is the dividend expense? The dividend expense is 5.2 lakhs. Therefore, whichever is lower, that is 4.8 lakhs will be allowed as deduction to you in this case. Now, after that, you will compute the tax. There are two kinds of income. One is LTCG, which will be taxable at 12.5%, and other incomes will be taxable at 22%. And on the total tax, you will impose 10% surcharge and 4% cess. So this is what this beautiful question is all about. Now, coming to the next question. Question number 2. Question number 2. It's a question on partnership firm. There are 3 partners, Vatsal, Vihan and Vayu are equal partners. The firm was formed in 2026, this year only. So it's a 10-year-old firm, 10-month-old firm, just 10-month-old firm. Now, what are you supposed to compute? You are supposed to compute just total income of the firm. No need to compute any tax, no need to compute any AMT, nothing, only total income. So whenever you compute total income of a firm, you have to compute first of all the book profits as per 40B. Then you will compute remuneration allowable to the partners, and then you will compute the total income. So let's compute all of them one by one. Net profit is 4,50,000. What is book profit? Book profit is nothing but PGBP only. In that PGBP, just add the remuneration if debited to PNL. So net profit is 4,50,000. The first item is depreciation on generator and computer, which is as per books of accounts, so add back. Second is partner salary, add back. How many partners? 82,000 salary, 3 partners for 10 months salary, add back. This is the actual salary. This is not allowed. This actual will be compared with maximum percentage allowed as per 40B, whichever is lower, that will be allowed. That we will see later on. Then 18% interest you are giving. Therefore, 6% interest disallowed, only 12% is allowed. Then you are giving donation to political party. Now you are giving 2 donations. One you are giving by cash. Cash is fully disallowed. One you are giving 70,000 by electronic mode. This will also be disallowed in PGBP. But later on, this electronic payment donation will be allowed as deduction under 80GGC. Later on, you can claim that as a deduction. Again, I am saying cash donation disallowed now also, and in 80GGC also disallowed. But the electronic donation, online donation which you have given will be disallowed in PGBP, but under 80GGC you can claim that later on. Be careful. Next, you are paying some rent to partner Vatsal. Now, firm and partner are always related party as per 48.2, remember. You cannot make payment in excess of fair market value to your partners. What is the market value of the rent? The market value of the rent is 15,000. How much you are paying? You are paying 36,000 to the partner. How much excess you are paying? You are paying excess of 21,000. For how many months? For 6 months. Add back that as per 48.2. You cannot make excess payment to partners in excess of fair market value. Therefore, the excess portion will be disallowed under 48.2. Next one, you are giving some benefit and perquisite to your customers in the form of gold coins. The gold coins are not exceeding worth rupees 10,000 rupees. So the value of the gold coin is up to 10,000 rupees. And you have not deducted TDS. Is it okay? Yes, it's okay. When you give any benefit and perquisite to any person in business and profession, you should deduct TDS under 194R only if the benefit and perquisite exceeds 20,000 rupees. If the benefit and perquisite does not exceed 20,000 rupees, the TDS under 194R is not applicable. Now, because the TDS under 194R is not applicable, therefore the expenditure should be allowed. Even though you have not deducted the TDS, because the provision of TDS is not applicable only in your case. Next, tangible assets depreciation 243 you can claim. And last but not least, you have purchased some trademark in July, but you have put to use in December. So you should claim 12.5% intangible asset depreciation because the asset is put to use for less than 180 days. You can claim 12.5% depreciation. After that, you compute book profit. And then find out the remuneration maximum allowed. Up to 6 lakh book profit, 90% of book profit. Above 6 lakh, 60% of book profit. Compare that with actual. Actual is how much? 82,000 into 3 into 10. Whichever is lower will be allowed. And then you compute the total income, gross total income. And after that, you reduce the chapter 6. In chapter 6, only one item will come. What is that one item? That's 70,000 rupees electronic donation given to a political party. Cash donation not allowed. That's it. They have not asked tax, so we are not computing tax. They only asked for total income, so I have computed the total income. I hope it is clear to all of you. Let's go ahead with the third question now. That third question is on charitable trust. There is a charitable trust registered under 12AB. The income of the trust is 500 lakhs. Now the trust is giving donation of 200 lakhs to another charitable trust. Now we need to identify whether this donation given to another charitable trust, which is also registered under 12AB, is it allowed or not in following circumstances. Circumstances number 1. Point number 1. If it is given as a general donation, not as a corpus donation. So if it is given as a voluntary donation to another charitable trust registered under 12AB, not as a corpus donation, is it allowed? The answer is yes, it is allowed. Voluntary donation given to another charitable trust registered under 12AB or 1023C is allowed, provided it is only allowed to the extent of 85% of donation given. You will not get more than 85%. If you are giving donation of how much? 200 lakhs in this case, you will get 85% of 200 lakhs, that is 170 lakhs. Second, in case 2, if this donation is given as a part of a corpus, then it is not allowed. Corpus donation given to another charitable trust not allowed as deduction. Corpus donation given to another charitable trust not allowed as deduction. Be very careful. Third part, will your answer change if the donation is given out of the accumulation of last year's? If this 200 lakhs is not given from current year income, but it is given from the accumulation of last year, it is not allowed. It is not allowed from both the cases. The donation should be given from the current year's income. If it is given from last year accumulation, it will not be allowed, and voluntary donation also not allowed. Corpus donation anyways not allowed. Next, part 2. The trust has received some corpus donation. Okay. We are supposed to identify what are the conditions subject to which corpus donation will be exempt, and what if they do not fulfill the condition, then what will happen. See, if you receive any corpus donation from any person as a trust, it will be exempt only if you deposit that corpus donation in the mode specified in 11.5. So if you deposit that corpus donation in the mode specified in 11.5, it will be exempt. And if you deposit that anywhere else other than mode specified in 11.5, it will be taxable, and it will be taxable under 115 BBI at flat 30%. It will be considered as violation of 115 BBI. So the rule is very simple. When you receive corpus donation, deposit in the mode specified in 11.5, and if you do not deposit in the mode 11.5, then it will be taxable at 30% under 115 BBI plus surcharge if applicable plus cess. No deduction of any expense will be allowed under 115 BBI. I hope it is clear to all of you. Let's go to next question. Question number 4. In question number 4, we are supposed to compute Mr. Amit, an Indian resident, his tax payable. Whenever tax payable will come, always remember you have to reduce from the tax liability, advance tax, TDS and TCS. Then only tax payable will come. Mr. Amit is opting for option to shift out of the 115 BAC. It means he is following old regime. So you have to compute tax as per old regime. Let's try to understand what Amit is doing. Amit is purchasing some virtual digital assets like cryptocurrencies and some non-fungible tokens also, NFTs. So Amit is purchasing some cryptocurrencies and NFTs. So what all things he has purchased? He has purchased one Bitcoin for 60 lakh rupees, first thing. Then his friend Sushil has given one NFT whose market value is 5 lakh rupees on his birthday, second thing. Then Amit also bought one NFT for 10 lakh rupees. So Amit has bought one at Bitcoin, then he got one NFT as a gift from his friend, and then he bought another NFT. Now, what is due to financial need? Amit needs some money. Therefore, he has sold half Bitcoin. So, for half Bitcoin, how much capital gains or how much gain will come? See, half Bitcoin is sold for 28 lakhs. What is the cost of the Bitcoin? The cost of one Bitcoin is 60 lakhs. Therefore, half Bitcoin will be 30 lakhs. Therefore, there is a loss of 2 lakhs. What is the treatment of this loss? Lapse. As per 115 BBD. Whatever loss comes in Bitcoin, whatever loss comes in virtual digital asset, it is not allowed to set off against any other income. It is not allowed to set off against this income also. This is lapse. Loss, there is no treatment for loss. This is gone forever. What is the next income for Amit? The next income from Amit is the gift from friend. If I receive a virtual digital asset whose market value is more than 50,000 rupees, that is taxable as income in my hand. Therefore, this 5 lakh rupees will be income in my hand. Because Mr. Sushil, who is my friend, he is giving me NFT of 5 lakh rupees on my birthday. So this 5 lakh will be income from other source. Apart from that, this NFT which I have received as a gift from my friend that I am selling later on for 6.5 lakhs. Check. So 6.5 lakhs will be the sale consideration of this NFT, and the cost of acquisition will be the FMV taken in 56,210. The FMV taken in 56,210 is 5 lakhs. Therefore, this 1.5 lakhs will be subject to 30% tax. And one more thing, Amit also has some other income of 6.5 lakh. So what is the total income of Amit? 4 calculations Amit has made. First, half Bitcoin, there is a loss. This loss is lapsed. Then 5 lakh rupees IFOS, that will be chargeable at normal slab rates, old regime. 6.5 lakh other income, that will also be chargeable at slab rates, old regime. This 1.5 lakh which is on transfer of NFT, this will be taxable at flat 30% without any exemption. Flat 30%. Even transfer expenses are not allowed for Bitcoins and virtual digital asset. Transfer expenses not allowed. Sorry. This transfer expenses are not allowed for Bitcoins and virtual digital asset. I hope it is clear to all of you. Now, they have asked for tax payable. I need to know tax payable. Is there any TDS deducted in case of Mr. Amit? Yes. When Mr. Amit has sold his Bitcoin for 28 lakh rupees and his NFT for 6.5 lakh rupees, so total 34.5 lakh rupees he has sold virtual digital asset, the buyer would have deducted TDS at the rate of 1%. On how much amount? When he sold 28 lakhs Bitcoin, on that 1% TDS would come to 28,000. When he sold NFT of 6.5 lakh, 1% TDS will come to 65,000, 6,500. Therefore, total 34,500 TDS would have been deducted by the buyer on sale of Bitcoin and virtual digital assets. Therefore, this should be taken as a credit while computing the tax payable. I hope it is clear to all of you. All these small points, you need to be very careful with it. Next question, again very intelligent question. There is a partnership firm by the name called as Paul and Company, in which Mr. Vivek is a non-resident partner, and this Mr. Vivek, non-resident partner, has put capital of 50 lakh rupees in the firm. Now the firm is giving him interest at the rate of 10%. The firm is also giving him share of profit. So the firm is giving him two things. Rate of interest is giving and share of profit. So I am a firm, you are a partner, you are a non-resident partner. I am giving you interest, I am giving you share of profit. I need to comment whether I should deduct TDS or not. So on interest, I should deduct TDS under section 194T, new section introduced from 1st April 2025. Why? If a firm pays interest, remuneration, commission, bonus, salary to the partner, then the firm should deduct TDS at the rate of 10% if the amount of payment exceeds 20,000 rupees in a financial year. So I should deduct TDS at the rate of 10%. When? At the time of credit to partner account or at the time of payment, whichever is earlier. Threshold is 20,000. So I should deduct TDS at the rate of 10%. What about share of profit? On share of profit, TDS is not deductible because share of profit is exempt in the hands of partners. Therefore, on share of profit, there is no need to deduct any TDS. But on share of profit, you should do related formalities like Form 15 CACB. You have to fulfill all these things. Okay. Now, there is another transaction over here. Mr. Vivek's friend is also there, Mr. Vikas. He is also non-resident. Now, he is providing some technical services to Palan company relating to project in India. So, Vikas is doing what? Vikas is doing some technical services he is giving to Palan company for some projects in India. So, this technical services, FTS, fees for technical services, is deemed to accrue or arise in India because the project is in India, the services are utilized in India, therefore, it is deemed to accrue or arise in India. Now, in this case, is this amount taxable in the hands of Mr. Vikas? There is no DTAA between India and country Y, X. Let's assume that. Now, therefore, this particular transaction is taxable definitely. Non-resident providing some FTS services for projects in India, it is deemed to accrue or arise in India as per 917. This is definitely taxable in India. Now, the question is, taxable as per what? 115A will not be applicable. Why 115A will not apply? Because for 115A to apply, there has to be an agreement between both the party and that agreement should be approved by central government. All those things are not there here. Therefore, 115A will not apply. Therefore, normal provision will apply. Normal provision means I have to deduct tax as per rates in force. What is the rates in force? The maximum rate which is applicable to individual is 30%. I will deduct TDS as per what? 31.2%. I hope it is clear to all of you. I will deduct TDS as per 31.2% and give the balance money to Mr. Vikas. Now, in second part it is given. And where I will deduct TDS? I will deduct TDS under 195. 115A is not applicable as there is no agreement which is approved by central government. Second part is a very intelligent part. If India has a DTAA, let's assume, in part 1 we have assumed that India does not have DTAA with country X. But part B we are assuming if India has a DTAA with country X and FTS is taxable at 10% for example, then what is the remedy available to the payer Mrs. Pal and Company if Mrs. Pal and Company India has deducted tax at the requisite rate provided under the Income Tax Act? So let's assume that India and foreign country has a DTAA and the tax is taxable, the FTS is taxable at 10%, but still Mrs. Pal and Company has deducted tax as per income tax rate of 30%. Then what is the remedy? In that case, there is a remedy available to Mrs. Pal and Company under section 239A with one assumption. The assumption is if the tax is borne by Mrs. Pal and Company, if the tax is borne by the payer, if the tax is paid by the payer by grossing of the income, then Mrs. Pal and Company will get remedy under 239A. What is that 239A remedy? The remedy is Mrs. Pal and Company has to make an application to the assessing officer within 30 days from the date of payment of tax for refund of remaining 20%. And the officer will grant refund of remaining 20% within 6 months by passing an order. But this remedy is only available to Mrs. Pal and Company. See, very simple. If Mrs. Pal and Company has borne the tax, then Mrs. Pal and Company deserves to get the refund. If the tax is borne by Mr. Vikas, then Mr. Vikas deserves to get the refund. So Mrs. Pal and Company will get remedy only if Mrs. Pal and Company has borne the tax. Otherwise, Mrs. Pal and Company will not get the remedy. I hope it is clear to all of you. This 239A is applicable only if the tax is borne by the payer. Go and check this provision we have done, I think on the last page of the non-resident taxation or second last page, either of the two page in our color book. Next question, question number 6. There is a buyer, Mr. Bhuvan, and there is a seller, Mr. Srinivas. The buyer is purchasing some raw material from Srinivas. Now the seller is insisting that make the payment in cash of 3,20,000 rupees for an invoice. So the buyer made the payment in cash. Now what is the treatment in the hands of Mr. Buyer and in the hands of Mr. Seller? See, very simple. You cannot, for buyer I am saying it, for buyer this 3,20,000 paid in cash will be disallowed under 40A3. Buyer cannot make the payment in cash in excess of 10,000 rupees. In excess of 10,000 rupees, if you want to pay to a person in a day, you should pay by 4 modes: account pay check, account pay draft, ECS and such an electronic mode. The buyer cannot make the payment in what? In cash. So for buyer the expenditure will be disallowed under 40A3. What about seller? Seller also cannot receive 2 lakh or more in cash in one entire day. or in with respect to one invoice in multiple days. Seller also cannot do that. If seller does that, seller will be liable for 269 ST and the penalty will be imposed under what? 271 DA. 269 ST will be attracted and penalty will be imposed under 271 DA. The assessing officer will impose the penalty from 1st April 2025. Earlier joint commissioner used to impose. Now all assessing officers can impose. Now second part of this question. Will your answer change? If purchases are done on two different dates, 1,80,000 separate invoice, 1,40,000 separate invoice. In the hands of buyer, again no effect will be changed. Nothing will change. The buyer will be subject to disallowance of entire amount. Because for buyer, more than 1,000 rupees in more than 10,000 rupees in a day should not be paid by other than 4 modes. So for buyer, 1,80,000 is more than 10,000. 1,40,000 is also more than 10,000. So for buyer, both the expenditure will be disallowed. What about seller? Seller will be escaped from 269 ST and 271 DA. Why? Because the transaction is happening on two different days. And on every day, the transaction value is not exceeding 2 lakh rupees or more. Therefore, seller will be escaped from 269 ST and 271 DA. I hope it is clear to all of you. Next question, which is on DTAA. Let's try to understand what is this DTAA question. Mrs. Sudha Sharma is 61 years age. She is a classical singer. She does concerts in India and country M. She visits country M every year for a few days. Therefore, majority of the time she is in India. Therefore, she is resident and ordinary resident, 100%. There is no doubt about it. Now, which regime she is following? Let's try to understand. She is trying to follow. We need to compute total income, net tax liability. If she opted out of default regime, it means she is following old regime. We need to follow old regime for her. Now, let's try to compute the total income of Miss Sudha. Now, which all income Sudha is earning? First of all, she is performing some concerts in India. 10 lakh rupees she is earning. You will put this in PGBP. Then another 12,245 from concert she is earning in country M. So you will convert that into rupees as per TTBR on the last day of the financial year. As per Rule 115. Rule 115 says that for conversion of foreign PGBP income into INR, you have to take TTBR on the last day. What is the TTBR on the last day of country M? For country M, the TTBR on the last day of the financial year is 80 rupees. So you will convert this as per 80 rupees. Then she also earns 10,000 rupees from country N, which is with respect to what? Which is with respect to again copyright. So this will also be converted as per TTBR on the last day of the financial year of country N. So for country N, the last day TTBR is 79. You will multiply this by 79 and you will take in India. Then she is earning some fixed deposit interest, 4 lakh rupees on that and 25,000 rupees interest from saving bank. And from this 4 lakh and this 25,000 rupees, she will get 50,000 rupees deduction under 80 TTB because she is a resident senior citizen and she will get deduction under 80 TTB, not 80 TTA. Then she pays medical insurance of 25,000 for herself and 30,000 for her resident husband. Therefore, herself and husband taking together, she can claim 50,000 rupees limit deduction under 80D for mediclaim because she is following old regime. And she deposits 1.5 lakhs in PPF, so she can claim deduction under PPF 1.5 lakhs under 80C. And then she makes 3 lakh rupees 5-year FD in the name of son. In the name of son, if you make an FD, you are not eligible for deduction. You should make in your own name. So if you make in the name of your son, then it is not allowed. Now, one important thing we need to understand. With country M, we don't have DTAA, but with country N, we have DTAA. Therefore, with country M, we don't have DTAA. Therefore, the income will definitely be taxable in India and country M also, and India will give relief. What about country N? Country N, we have DTAA. Therefore, we need to identify this country N income is there, this $10,000. It is taxable in India or not? We need to understand Article 12 of DTAA between India and country N. For that, royalty and fees for included services arising in a contracting state. Where it is arising? It is arising in country N. It is accrued in country N. Paid to a resident of other contracting state. Where is the resident located? In India. Paid to a resident of India may be taxed in that other state. It means it may be taxed in India also. Therefore, this royalty will be taxed in country N also, and this royalty will be taxed in country India also. Therefore, we will include in India and we will give relief as per Article 23A, Article 23, elimination of double tax, which is similar to Section 91 unilateral relief only if you read this paragraph. So now we have included all the income. Concerts, Indian concerts 10 lakh. Royalty from country N will be taxable here also, there also. Royalty from country M, concert from country M will be taxable here also and there also. Then fixed deposit from Indian bank, and then bank account, saving bank account interest. From that 80C deduction, 80 deduction, 80 TTB deduction. After that, I will get 29,44,600 as total income. I will apply slab rates as per old regime because the assessee is following old regime. Old regime, Senior citizen, therefore up to 3 lakh rupees, no tax, above 3 lakh 5%, above 5 lakh 20%, and about 10 lakh 30%. Therefore, my tax is coming to 693 plus cess 721 is my tax. Therefore, average rate in India is 24.489. Now I will compare this average rate in India with average rate in foreign country and I will give the FTC. Now I will go by country by country. Now in case of India and country N, what is the doubly tax income? In case of India and country N, the doubly tax income is 7,90,000. Therefore 7,90,000 into India's average rate. This is one tax. Compare with the tax paid in country N. What is the tax paid in country N? Whichever is lower, that will be allowed as deduction. The tax paid in country N, you have paid tax at the rate of 10% of 10,000. 10% of 10,000 is $1,000. Now this $1,000 you have paid on 25th of March. So this you have to convert into rupees as per Rule 128. What does Rule 128 says that? Rule 128 says that you have to convert the foreign tax into Indian tax for the purpose of credit as per TTBR of the last day of the preceding month. So you are paying in March 25. So you have to take 20th Feb TTBR. What is 20th Feb TTBR in country N? The 20th Feb TTBR in country N is 78 rupees. Therefore, you have to convert this into 78 rupees and this 78 rupees will be considered as foreign tax and you will compare your Indian tax with your foreign tax and whichever is lower will be allowed as deduction. So always remember, for converting foreign income you apply Rule 115, but to convert foreign tax you apply Rule 128. Similarly, for country M, what is the doubly tax income? For country M, the doubly tax income is 979,600. So I will write 979,600 over here into what is the average rate tax paid in India. It is 24.489, that is 239,894. And what is the tax paid in foreign country? We need to again check over here. They have given the data of tax paid in foreign country. In country M, you have paid $2,500 in the month of October. So you have to again take the TTBR of 30th September. The TTBR of 30th September in country M is, in country M, the TTBR of 30th September is 80 rupees. So you will convert this $2,500 into 80 rupees. And therefore, as per 80 rupees, it will come to how much? It will come to 2 lakh rupees. Check please. So you will take this as 2 lakh rupees. You will convert this into 80 rupees. And this will come to what? This will come to 2 lakh rupees. Therefore, whichever is lower will be allowed as relief. And ultimately, these two reliefs will be reduced from your tax. And therefore, net tax payable will be 443,120 after rounding off. I hope it is clear to all of you. Very good question. Question number 8. Sir, what is question number 8? Again, you need to find out the tax liability of Mr. Manan under default regime, under new regime. What is Manan doing? Manan was staying in country X for a long time. Now he came to India permanently on 1st February 2025. That is last year. Just 1 month back, just 2 months back, he has come to India permanently. Therefore, Manan is staying in India in the current year for 365 days and in the last year only for 60 days. Therefore, Manan is definitely resident, but Manan is not ordinary resident, but because Manan will not fulfill the additional conditions of ordinary resident. What is the additional conditions of ordinary resident? He should stay in India for 730 days in last 7 years. That is not going to happen. He was permanently settling outside India. Now he has come to India just 60 days back. Plus, he should be resident in India in at least 2 out of last 10 years. That is also not possible. Therefore, Manan is resident but not ordinary resident. Now we need to understand which incomes of resident and not ordinary residents are taxable in India. Only incomes which are accrued in India or deemed to accrue in India, or only incomes which are received or deemed to receive in India. And in case of PGBP, if the business is done outside India but controlled from India, or if the profession is done outside India but set up in India, only then it is taxable. If an income is accrued outside India, received outside India, then that is not taxable for NOR. That is only taxable for R and OR. Therefore, Manan is earning what? Manan is earning some rental income from country X. See, the rental income from country X will not be taxable in India. Why? Because this is accrued outside India. This is received outside India in the bank account in country X. Therefore, that will not be subject to tax in India. What will be taxable in India for Manan is only the business income in India of 12,50,000. That Manan will pay tax in India. And along with that, Manan has purchased some land in Indore on 18th of March 2023 for 30 lakhs. Now Manan is selling that land on 23rd of December 2025 for 80 lakh rupees. So this land is sold after 24 months and this land is situated in India. Therefore, this capital gains will be chargeable to tax in India. Okay. Now, but on this 50 lakh rupees, Manan has two options. That's the catch in this question. Which two options? Which two options? The two options which is given to the grandfathering assessees. That is, if an assessee is resident and he is purchasing land and building before 23rd July 2024 and he is selling land and building on after 23rd July 2024, then he has two options. He can take 12.5% without indexation or 20% with indexation. Manan has both the options. Check. So on LTCG, you will apply both the option, whichever is beneficial, you will take that. And on business income, you will apply slab rates as per new regime. I hope it is clear to all of you. That is the reason they have given you indexation also. All this TTBR, TTSR is not useful. It is for time pass. It's of no use to us. I hope it is clear to all of you. And one last question over here in this particular RTP. It is a very big RTP. One of the best RTPs out of 9 RTPs is this one. It's very big and all questions are also very good. So there is an Indian company, Triveni, Triveni Cement Limited, TCL, and which is having a head office at Chennai. Now, there is a foreign subsidiary Drift Inc. which is of Triveni. Therefore, that Drift Inc. and Triveni are what? Associate enterprise. Now, Drift is paying some royalty. Drift is paying some royalty of $3 million to Triveni. So, Triveni is providing some services. Drift is paying royalty of $3 million to us. Whereas Triveni is receiving royalty from others at $4 million. So, I am Triveni from associate enterprise Drift Inc. I am taking $3 million. But from others, I am taking $4 million. From associate enterprise, I am taking $1 million less. $1 million means 10 lakh. $10 lakh less I am taking. Therefore, that much I have to add back. $10 lakh into 82 rupees is the rate of dollar which is given over here in the question. Where it is given, 82, somewhere it is given. Here it is given. So 10 lakh into 82, that will be added back. Again, I am saying, I am Triveni, I am in India. When I am giving services to my associate enterprise Drift, so I am taking $3 million. When I am giving services to third party, I am taking $4 million. Therefore, I am taking $1 million less from associate enterprise. That I have to add back into 82. Therefore, I have to add 820 lakhs over here. Second issue, TCL has borrowed 220 crore from Swift Inc. So whether TCL and Swift are deemed to be associate enterprise? If yes, whether transfer pricing adjustment will be made? Yes, TCL and Swift are deemed to be associated. Why? See, TCL has taken how much loan? 220 crore. And the balance sheet of TCL says that the book value of the asset of TCL is 330 crores. So out of 330 crore asset of TCL, 220 crore they have taken as a loan from Swift, which is 67% approximately. Therefore, if one entity finances 51% of the book value of the asset, market value is not relevant for me, then both of them are deemed to be associate enterprise. Therefore, TCL and Swift are deemed to be associate enterprise. Now, we are paying how much interest? We are paying how much interest to Swift? We are paying 8% interest to Swift, whereas the market rate is 7%. So, we are paying 1% extra. We are paying 17.6 crore. Therefore, 17.6 crore we are paying at 8%, which is 1% extra. Therefore, 1% is how much? Cross multiply. That will be added back to your income statement as a transfer pricing adjustment. So, to our associate enterprise, we are paying 17.6 crore, which is 8%. To others, the normal rate is 7%. Therefore, 1% extra. Therefore, add back. Third transaction. TCL supplies goods to True Words Limited. The paid up capital of True Word is 92 crore and TCL holds 22 crores. So let's check how much percentage it holds. So 22 crore divided by 92 crore comes to approximately 23.91%, approximately 24%. Therefore, they are not associate enterprise. Because they are not associate enterprise, transfer pricing adjustment cannot apply in this case. I hope it is clear to all of you. So out of 3 transactions, 2 transactions are subject to transfer pricing, 1 is not subject to transfer pricing. So this is what this RTP is all about. How did you like the RTP? Please comment below. Let's go ahead with the next RTP, that is RTP September 2025. Again, the first question is on total income. Now we need to read the last line. We need to compute total income. As per the normal provision, do not go for 115 JB or do not go for concessional tax regime. Nothing has to be done. Just total income as per the normal provision. Not even tax computation is asked. Okay. So let's start with the first adjustment. Assassi is a company, Rainbow Limited. The profit of the Assassi is 27,22,000 rupees. The very first adjustment is Assassi has taken some loan for purchasing some land. On that land, they will construct some factory building. For which approval is not yet received. So because the approval is not yet received, whatever interest you have incurred on loan, that will be capitalized. Okay. That will not be allowed as deduction. That will be disallowed over here. Whenever the building will be ready, at that time the interest will be capitalized till the time the building is not put to use, till the time the building is put to use. After that, interest will be allowed as deduction. So as of now, because the building is not ready, the approval is not received, you have to disallow this interest. You have to capitalize this interest. Whenever it will be ready in the next year, that time you can claim that as a depreciation. Okay. Next one, you have paid some commission of 1 lakh rupees in the month of February. You have deducted TDS in February and you have paid the TDS in September. Absolutely correct. When you want a deduction of an expense, you should deduct the TDS in the same financial year by 31st of March and you should pay till the due date of filing of return. Therefore, in this case, the assessee has deducted the TDS before March but paid and also paid till the due date of filing of return. Therefore, this 1 lakh rupees will be allowed as deduction. But the problem is with this 1,25,000 rupees. On this 1,25,000 rupees, which is paid in the month of March, the TDS is deducted in May. Now here they have made a mistake. The TDS should be deducted by March. If you don't deduct TDS by March, it will be disallowed in the current year. Even if you deduct the TDS of March on 1st of April, still in the current year, the expenditure cannot be allowed as deduction. Therefore, this 1,25,000, 30% will be disallowed under section 40A1A, and in the next year, it will be allowed as deduction. This is disallowed because of late deduction. Okay. Now, you are incurring some travel expenses for foreign tour of director, and directors are going outside India for new line of business. This is disallowed. Now, you need to be very careful. Don't get confused with something which we have done earlier. Whenever you incur some expenses for foreign tour for director, where the director goes outside India for existing business, then it is allowed as a deduction. Earlier one adjustment has come similar. You will find that in that adjustment you have allowed the year we are disallowing, both are different. There the directors were going for existing business. So if the directors are going for existing business, it will be allowed. But if the directors are going for new business, it will be disallowed. Okay. Next one. There are some outstanding interest of 3 lakh rupees. Now the company is converting that outstanding interest into a new loan. Conversion of outstanding interest into a new loan does not amount to actual payment. Therefore, that conversion will be disallowed. However, that new loan, whenever that new loan will be paid, that will be allowed as deduction. So, how much you have paid? You have paid 50,000 out of that. Therefore, the 50,000 rupees will be allowed as deduction. So, 3 lakh rupees will be disallowed and 50,000 will be allowed as what? Deduction. I hope it is clear to all of you. Next one, EPBAX and mobile phones, they are subject to 15% depreciation, but mistakenly you have taken 40% depreciation. Therefore, 25% depreciation on EPBX and mobile phone will be disallowed. So, 25% you have to disallow. Okay. Next one, there is a wholly owned subsidiary over here, S Limited. Now you are giving a contribution, you are giving a donation of 5 lakh rupees to that wholly owned subsidiary. For what? For construction of school. For whom? For the benefits of the employees. So this is allowed as reduction. There are some High Court judgment which says that if you give some donation to your wholly owned subsidiary for the welfare of the employees, for construction of school, ultimately it will help in welfare of the employees, which will help in the business. Therefore, it shall be allowed as what? It shall be allowed as deduction. Next one, dividend you are receiving from a company. So, whatever dividend you are receiving, reduce from here and show under PGBP. How much dividend you are receiving? 10,000 the equity shares into 10 rupees each. Therefore, 1 lakh rupees dividend you are receiving, reduce from PGBP, show under IFOS. Okay, do not gross up, do not gross up. See, ICI has been taking a stand that nowadays ICI does not gross up dividend unless and until it is written in the bracket that it is net of TDS. Unless and until it is written net of TDS, don't gross up. Earlier they used to gross up dividend received every time, but now they are not grossing up. Unless and until it is written, it is net of TDS. So please don't gross up. Okay. Then there is a grandfathering clause over here which you can apply. Reduce the profit from PGBP and show under what? Show under capital gains. How much is the profit? The profit on grandfathering clause capital gains is 3 lakhs. Reduce from here and show under capital gains. Tax at 12.5% in excess of 1.25 lakh. Now, whenever the date 31st Jan 2018 will come, always remember there is a concept of grandfathering clause. Next one, very, very simple adjustment. There is a provision for gratuity as per actuary. So, the provision for gratuity as per actuary of 6 lakh rupees will be disallowed under 40A7, and whatever you have actually paid will be allowed. So, actual paid will be allowed and actuary provision will be disallowed over here. Last one or two adjustment, that is bonus of last year bonus 2024-25, which was paid on 15th of November 2025. So last year bonus paid in the current year. Therefore, bonus of last year will be disallowed in the last year because bonus is allowed on payment basis. Now last year it was not on paid on time. Therefore, last year this 98,000 would have been disallowed. But in the current year it should be allowed because it is paid. But in that also you have made a mistake. You have paid 34,000 by bearer check. Therefore, I will not allow you full 98,000. Out of 98,000, 34,000 will not be allowed. Therefore, only 64,000 will be allowed. For 34,000, you can write a note that this will be not allowed because it is paid in bearer check. Okay. Last but not least, you have purchased some commercial vehicle of 8 lakh rupees on 21st of March 2026 and you have claimed full depreciation of 15%, which is wrong. You cannot claim full depreciation. You can claim only half depreciation, and this is also debited to the statement of P&L. If this would have not been debited, then it would have been a different case, but you have debited that to P&L. Now, because you have debited to P&L, You have to add back 50%. So you have wrongfully claimed 15%. You should claim only 7.5%. Therefore, 7.5% will be disallowed in this case. Okay. That's the only thing which is asked. No 115 BAA, no MAT, no tax calculation also. Only total income as per the normal provision. I hope it is clear to all of you. Let's go ahead with the next question. Question number 2, which is on charitable trust. So there is a charitable trust registered under 12AB, engage in preservation of forest. The very first question over here is, they are following mercantile system of accounting. Now they have incurred some electricity expenses of 1,20,000 in 25-26, but it was paid in 26-27 on 15th April 2026. So when they will get the deduction? See, always remember, for charitable trust registered under 12AB or 1023C, their deductions are allowed on payment basis. So even though the expenditure is of 25-26, but the deduction will not be allowed in 25-26, the deduction will be allowed in 26-27 only on payment basis. Trust get deduction on payment basis, not on accrual basis. This is the first point. Second, the charitable trust is earning some agricultural income of 10 lakh rupees, which is exempt under 10(1). Will they be eligible for this exemption? The answer is yes. Generally, if you are registered as a charitable trust under 12AB, then section 11 subsection 7 says that no exemption under section 10 will be allowed to a trust except 10(1). 10(1) a charitable trust can claim. So in this case, charitable trust can claim what? 10(1). They cannot claim other exemptions. So in this case, charitable trust, along with the exemptions of section 11, 12, they can also claim agriculture exemption under 10(1). So this is also correct. They can claim exemption under 10(1). Third one, the charitable trust has earned rental income of 4 lakh rupees. They have earned 4 lakh, out of which 3 lakh is received in the current year, 1 lakh is not received, 1 lakh is received in future. So you might have done one point with me in the class, that if you have not received a particular amount, then how will I apply? So you can make an application, the trust has make an application that whenever I will receive, I will apply at that time. So the trust has exercised for the relevant option. That 1 lakh rupees I have not received, whenever I will receive, I will apply. So the law says that you should apply when you receive, or you should apply the year following the receipt. Otherwise, it will be deemed income of the year following the receipt. So 3 lakh rupees you have received, that's okay. You have applied. 1 lakh rupees you have not received, so you have made an application for deferral. You have made an application for deferral. You said that I will apply this in future. When have you received? You have received on 31st August 2026. Now what is your duty? Your duty is to apply by 31st March 2027 or 1 year extra grace by 31st March 2028. You should apply in the year of receipt or the year following the receipt. The year following the receipt is 27-27. So you should apply till 31st March 2028. If you don't apply till 31st March 2028, it will be deemed income of 31st March 2028. I hope it is clear to all of you. Question number 3. A similar question we have done earlier. Point number 1 we have done earlier, similar. Not exactly similar, but kind of similar. Mr. Raju is a buyer and Mr. Sandeep is a seller. Raju is buying some scrap of 55 lakh rupees. Now generally, if a seller is selling scrap, then he should collect TCS under section 206C subsection 1. Because in 206C subsection 1, scrap is covered for TCS. So Mr. Raju is buying some scrap of 55 lakhs from Sandeep. So Sandeep should collect TCS technically. But Raju is resident. And Raju is saying that, no, this scrap I am not buying for my trading purpose. This scrap I am buying for manufacturing purpose. Or if Raju says, for example, I am buying this scrap for power generation, then in that case, Sandeep will not collect TCS as per 206C subsection 1A. That if a buyer gives a declaration that he will use this particular items for power generation or for manufacturing, that the seller should not collect TCS. Then in that case, it is the responsibility to deduct TDS under 194Q by buyer if the other conditions of 194Q are fulfilled. The buyer should deduct TDS in that case. Now let's see whether the buyer is liable for deducting TDS or not. Let's see whether the buyer is fulfilling the conditions or not. The buyer, Mr. Raju's last year turnover is more than 10 crore, check. So the buyer's last year turnover is more than 10 crore and buyer is buying goods of more than 50 lakh rupees. Therefore, buyer will be liable to deduct TDS in excess of 50 lakh rupees. That is on 5 lakh rupees, 0.1% at the time of credit or at the time of payment, whichever is earlier under 194Q. So in this question, seller is exempted from TCS, but the buyer is liable for TDS on 5 lakh rupees, 0.1% on credit or payment, whichever is earlier. I hope it is clear to all of you. Next one. Mr. Rajat has taken a loan of 12 lakh rupees from employer for what? For education outside India of his daughter. Out of that, he has remitted 9,75,000 to the university outside India. Whether TCS will apply or not. See, if you take a loan from employer, that is different if you take a loan from a financial institution in India. If I take a loan from a financial institution in India and then I send outside India for education purpose, then TCS is not applicable, only exempted. But if I take a loan from employer in India and then I send outside India, then TCS is applicable in excess of 10 lakh rupees. Up to 10 lakh rupees exempt, about 10 lakh rupees 5%. So here I am taking loan from employer, therefore I will not get complete exemption. I will get exemption up to 10 lakh, about 10 lakh 5%. So in this case, I have taken a loan of 12 lakhs, but I have remitted only 975. Now because 975 is less than 10 lakh, therefore here no TCS will be applicable in this case. I hope it is clear to all of you. Next one is something which we have done earlier also, but a very important case law of Travel Designer India Private Limited, Supreme Court judgment, recent judgment of 2025. What has happened in this case? The SSC has filed an original return on 15 September 2024. Then the AO said that there is a defect in this original return, so the AO has told to rectify the defect, and the SSC rectified the defect in the next year. So the return is filed on 15 September 2024 and the defect is rectified in the next year on 19 May 2025. Now the question is, what is the time limit to send a scrutiny notice? The time limit to serve scrutiny notice is 3 months from the end of the financial year in which the return is furnished. Which return? Original return or rectified return? Original return or when the defect is cured. So the Supreme Court said that the 3 months from the end of the financial year in which the return is furnished will be counted from the year in which the original return is furnished and not the rectified return. So 3 months from the end of the financial year will be counted from 3 months from the end of the financial year in which the original return is furnished and not when the defective return is furnished. I hope it is clear to all of you. So this is what this question is all about. Next question, very simple question once again. It's a question on penalty computation. Mr. Kabir is following old regime. He opted out of default regime. Now his total income as per return is 35 lakhs. Then return is processed 45 lakhs. Then income is assessed 85 lakhs and income is reassessed at 1.05 lakhs, that is 1.05 crore, sorry, that is 105 lakhs. Now we need to suppose to compute the total income. We are supposed to compute the penalty not on account of misreporting. It means penalty is 50%. Very simple question. First penalty will be imposed under 143.3 and then penalty will be imposed after 147. Under 143.3, how the penalty will be computed? Underreported income will be computed, step number 1. Then tax on underreported income, then penalty. What is underreported income? Income assessed minus processed. What is income assessed in 143.3? 85 lakhs. What is income processed? 45 lakhs. This 40 lakhs is underreported income. Now will I compute tax directly on 40 lakhs? No, never compute tax on directly 45 lakhs. 40 lakhs. First compute tax on 85 lakhs. When you compute tax on 85 lakhs, you have to apply surcharge of 10%. And then compute tax on 45 lakhs. When you compute tax on 45 lakhs, no surcharge. And then cess, and then you will apply 50% penalty. Similarly, underreported income at the time of 147. Income reassessed 105 lakhs. Income previously assessed 85 lakhs. Check please. Reassessed 105 lakhs, previously assessed 85 lakhs. Therefore, underreported income is 20 lakhs. Now, how will I compute tax on this? Will I compute tax directly on 20 lakhs? No. That is the catch. First, you will compute tax on 105 lakhs, then tax on 85 lakhs. Tax on 105 lakhs, when you will compute, you will apply surcharge of 15%. Tax on 85 lakhs, when you will compute, you will apply surcharge at 10%. And then you will compute the tax. On that, you will apply surcharge. On that, you will apply cess. I hope it is clear to all of you. And then you will apply 50% penalty. Next question is also a very good question. There is a foreign company which is incorporated in Belgium. This foreign company is doing two things. First, it is selling raw diamond in special notified zone. Where is special notified zone? It is in Mumbai, Bharat Diamond Bourse, and in Surat Diamond Bourse. So this foreign company is selling raw diamonds in Mumbai and also in Surat. This foreign company is also displaying raw diamond in what? In special notified zone, that is Bharat Diamond Bourse, Mumbai and Surat. So now the question is, this foreign company is doing two things: selling raw diamonds in Mumbai, selling raw diamonds in special notified zone, and also displaying raw diamonds in special notified zone. Are they eligible for safe harbor rule? Now let me tell you who is eligible for safe harbor rule and who is not eligible for safe harbor rule. First of all, let me talk about the display point. If a foreign company comes to special notified zone and display the raw diamond and earn income, that is not considered as income accrued deemed to accrue arise in India. As per section 9, it is not taxable. And because it is not taxable, therefore they will not be liable for safe harbor rule also. Someone who is not taxable, only the question of safe harbor rule will not come only. Second possibility, if a foreign company comes to special notified zone and sell raw diamonds, then safe harbor rule is applicable. And then the safe harbor rule is, whatever is the revenue of that 4% should be shown minimum as profit. If you show lesser than 4%, safe harbor rule will not apply. If you show more than 4%, safe harbor will apply. Then you will not get deduction of any expenses. I hope it is clear to all of you. Question number 7, beautiful question. We have done a similar question earlier also, which was bigger than this, but this is also a good question. That is the reason I am discussing once again. Kanika is a resident. She is earning income from India, country X, country Y. Now she is following what? She is following default regime, new regime. We need to find out the net tax liability of Kanika. So let's try to compute the total income of Kanika first. In India, she is earning house property income of 4.3 lakhs. Directly income is given. Therefore, no need to take 30% standard deduction once again. There is a loss of 1.3 lakhs in 1.3 crores in foreign country. Therefore, the net income is 3 lakhs. Then take 9 lakhs singing profession income, 2 lakhs singing profession income. Then 5.5 lakhs from the owner of cricket team Delhi Super Players. Then other businesses income you should take. Share of profit from country X is taxable. In India, share of profit is from a firm is exempt. From foreign country it is taxable. Agriculture income in India is exempt. Agriculture income in foreign country is taxable. You take a total of all of them, you will get somewhere around 35.6 crores. Now compute tax on this. How? Don't compute directly. Partial integration you have to apply because there is an agriculture income in India which is exempt at the rate which is exempt to the extent of 1.5 crore. Compute partial integration. How? Step number 1. Step number 1 will be tax on this plus agriculture income. Step number 1. Step number 2 will be tax on agriculture income plus basic exemption limit. Then the difference between both of them will be the tax. On that you will apply 25% surcharge because the income is more than 5 crore. In new regime you will apply 25% surcharge, 4% cess. You will get your tax in India 13 crore 86 lakhs. You will get your average rate in India. Then you have to find out average rate in foreign country. Now average rate in foreign country is not directly given. They have given you tax paid in country X and tax paid in country Y. Now because they have given you tax paid in country X and tax paid in country Y, you can find out average rate. How? Tax in country X divided by income of country X, tax in country Y divided by income of country Y. Sir, how did you find out this income? By reading this paragraph. In country X, this loss is not allowed. See, in country X, it is written over here. Loss from house property is not allowed. Therefore, this loss will not be allowed to set out. In country X, this 7.2 crore is taxable. This 4.8 crore is also taxable. Therefore, in country X, 12 crore is taxable. Similarly, in country Y, this 2 crore is taxable, this 2.9 crore is taxable, and even agriculture income is taxable in country Y. Check. In country Y, agriculture income is taxable. Therefore, the total income of country X is 12 crore and the total income of country Y is 6.1 crore. You will get the average rate when you multiply by this, and then that average rate you will compare with Indian rate. What is the Indian average rate? 38.956. Whichever is lower, that you will apply on doubly tax income. How to compute doubly tax income? That everybody knows. Whatever is the doubly tax income, on that you will apply the lower rate and then you will get the relief. I hope it is clear to all of you. So this is what this RTP is all about. Let's go ahead with next RTP, that is RTP Jan 2026. The very first question over here is, pay attention please. You are supposed to compute total income, tax liability as per normal provision, also as per the concessional regime under 115BAA. And you are also supposed to say which option is beneficial. You are supposed to ignore MAT, no MAT is required. And the turnover of last to last year is 402 crore. Therefore, the tax rate over here will come to 30%. Okay. Now, let's start the question as per normal provision first, and then we will talk about in 115BAA which all items are not allowed. Okay. Now, the assessee is engaged in manufacturing some automobile items, and then the profit of the assessee is 8 crore 25 lakhs. The very first adjustment is depreciation that you will add back. Okay. The next adjustment is you are giving some donation to a political party by account paycheck. Therefore, in PGBP it will be disallowed, but in chapter 6A in 80 JGB, 80 GGB you can take that deduction, because in normal provision it is allowed if you make the payment by online mode, but in 115BAA it will not be allowed. Okay, I am saying side by side 115BAA effect also. Next one, there is some long-term capital gain of 6,18,000 rupees on listed equity share on which STT is paid both at the time of purchase and sale. Therefore, this equity share, this long-term capital gains is covered in 112A. Therefore, reduced from PGBP 6,18,000 show under capital gains, and in capital gains 112A will apply 12.5% tax in excess of 1.25 lakhs. Okay. Next one is a very important adjustment for us. Very important technical adjustment. You have purchased you have imported some machinery from Japan for 65 lakh rupees. And you have installed that machinery in December 2024. Be very careful. Very intelligent adjustment. You will say that, no sir, we have done similar adjustment earlier. No. You have not done similar adjustment earlier. So you have imported some machinery from Japan for 65 lakh rupees in December. Now, you have made some foreign currency payment because you have done some hedging contract and there is a loss on foreign currency payment. So this loss, what happens? You have to add back this loss to PGBP. PGBP it will not be allowed as per section 43A, and you should add back this to the add back to the cost of asset and claim normal depreciation and additional depreciation. Now, but in this question what you will do, you will just add back this loss of 2 lakh rupees to your PGBP income. Don't add back to the asset and claim normal and additional depreciation. Why, sir? We have been doing that earlier, sir. No, you don't do that, because in the additional information it is given that When you will take this depreciation now, 1 crore 18 lakhs, that already includes the depreciation on imported machinery. Additional and normal depreciation both are already included in this 1 crore 18 lakhs. Now, when you will reduce 1 crore 18 lakhs, you will by default reduce the normal and additional depreciation on that entire machinery. So why are you doing it once again? So be very careful. What is the treatment of this? The treatment of this is very simple. Whatever loss is there, add back that. That's it in the normal provision. In 115BAA, whatever additional depreciation will come on this amount, that additional depreciation on 67 lakhs you have to add back. Okay, I hope it is clear to all of you. So again, I am saying, first of all, this loss you have to add back. In PGBP, add back. Then don't claim normal and additional depreciation separately in normal provision, because that is already included in 1 crore 18 lakhs. But when you do 115BAA, just add back the additional depreciation on 67 lakhs, because in 115BAA, additional depreciation is not allowed as a reduction. Very, very, very important adjustment. Next one is also a very important adjustment. The assessee has borrowed some fund from Andhra Pradesh Industrial Development Corporation and some Andhra Pradesh State Financial Corporation. The total accrued interest is 11,56,900. Now the assessee is converting this interest, outstanding interest, into equity shares. Is that allowed as a deduction? The answer is yes. If you convert an outstanding interest into a new loan, not allowed as deduction. If you convert an outstanding interest into a bond, debenture or any other security where the liability to pay is deferred to future date, then it is not allowed as deduction. But if you convert that outstanding interest into an equity share, it is allowed as deduction. Very recently, Telangana High Court has given a judgment that conversion of outstanding interest into equity shares will be allowed as deduction, because when you convert an outstanding interest into equity share now, there is no liability. The liability of the company is discharged. Company is not liable to pay anything to anyone now. There is no liability in the balance sheet which the company has to pay. Therefore, it is allowed as a reduction. Always remember. Okay. Next one is also very intelligent adjustment. Be very careful. You have taken a loan of 6 crore 74 lakh for acquiring a machinery. You have taken a loan on 1st of June 2023. Now, the machinery is put to use on 1st of February 2025. Okay. So, you have taken the loan on 1st February 2024, and after 8 months, the machinery is put to use. So, first of all, compute the interest of the machinery. 674 is the total loan, multiplied by 10% is the rate of interest, multiplied by 10 will be number of months from June to March, divided by 12. This is the total interest which is there. Okay. Now, first of all, add back this full interest. Why? Because this interest is not allowed as a reduction. It will not allowed as a reduction now. First of all, add back this full interest. Now, what will happen with this 10-month interest? From 1st June to 31st Jan, that is 8th-month interest will be added to the asset, and you will claim depreciation and additional depreciation. Again, don't take separately while computing normal regime, because this also is already included in 1 crore 18 lakh check. Machinery purchase through borrowed from HDFC. This additional and normal depreciation also included. So what is the only treatment that you will give over here? You will add back. Okay. Add back the addition, add back the entire interest to the PGBP, and whatever effect has to be done, that the company has already done while computing the depreciation. Don't give anything else. Okay. Now, out of this 56 lakh, how much will be added to plant and machinery? 8-month interest will be added to plant and machinery, 44.93, and the 2-month interest will not be allowed as deduction. Why, sir? Because the interest is paid after the due date of filing of return. Therefore, 2-month interest will not be allowed. Don't do all this calculation while computing normal regime. This is relevant for computing 115BAA, because in 115BAA you have to add back the additional depreciation. Therefore, while adding back the additional depreciation, you have to take the cost of asset as 674 plus 44.93. That will be added back, because that is the actual cost of the asset. I hope it is clear to all of you. Again, I am saying, whatever interest is coming, whatever interest is coming, first of all, disallow in PGBP. Okay. Just that's the only thing you have to do under the normal provision. When you go to 115BAA, the 8-month interest you add to the cost of asset, and then you will get the actual cost of the asset. Of that additional depreciation you will add back. Okay. Additional depreciation you will add back 10%. Okay. I hope it is, because the machinery is put to use for less than 180 days. Now, the next adjustment is a very simple adjustment. We have done this lot of time in the examination, in the class earlier also, in the paper also. You are giving some donation to a scientific research institution, so you can claim that deduction under the normal provision. Under 115BAA, it will not be allowed. Okay. Next one is also a routine adjustment we have done earlier. You have sold some goods of 18.5 lakhs. Out of that, 11 lakh has become bad debts. Now later on, therefore, now how much is the debtor in the balance sheet? Out of 18.5 lakhs, 11 lakh has become bad debt. Therefore, debtor is how much? 7.5 lakhs. Now the question is, out of this 7.5 lakhs, while recovering, now the debtor is dead. The debtor expired. The debtor passed away. Now you are fortunately recovering more than 7.5 lakhs. So you are recovering 9.8 lakhs rupees. And the entire amount you are crediting to P&L. You should not do that. You should only tax 2.3 lakhs now, because this 7.5 lakhs is already included in the sales earlier and you have already paid tax. Therefore, you should only take what? 2.3 lakhs in the income, but you have unfortunately taken full 9.8 lakhs in the income. Therefore, reduce 7.5 lakhs from your PGBP income. Then you have to reduce what? 1 crore 18 lakh 50,000 rupees from your PGBP income, and then you have done some mistake once again. You have purchased some goods of 12 lakh rupees, which is not debited to the statement of P&L account in last year. Okay, so in the current year, you have purchased some goods of 12 lakh rupees, which is not debited to the P&L account. Okay, now. You have purchased this goods from micro enterprise and you have made a commitment that I will make the payment within 30 days. So again, I am saying 12 lakh goods you have purchased not debited to P&L on 13th March from a micro enterprise, and you have made an agreement that I will make the payment within 30 days. Now you made the payment after 30 days. Check. From 13th March to 14th April, it is after 30 days. Now, because you have made the payment after 30 days, you will be getting the deduction on payment basis. Now, the payment is happening when? Payment is happening next year, 14th April 2025. Therefore, in the current year, the expenditure will not be allowed. This is not debited to P&L. Therefore, don't take the deduction. If this would have been debited to P&L, I would have added back. This is not debited to P&L, so don't reduce. If this would have been already debited, I would have added back. I hope it is clear to all of you. This is how you have to read the words. Now, one last thing. After that, you have to compute the total income and tax as per normal provision. Tax, I have already told you, 30%. Now in 115BAA, what will happen? 4 items will be added back. First, donation given to political party will be added back in 115BAA. Then scientific research donation will also be added back. Then additional depreciation on imported machinery. At that time, it would be relevant. Okay, while computing the normal provision, don't take additional depreciation because that is already included in 1 crore 18 lakh 50,000 rupees. Then additional depreciation on local machinery, which you have borrowed from HDFC loan, that should also be disallowed over here. These 4 items you have to disallow. Once you do this, you will get what? You will get your total income as per 115BAA. Then on capital gains income, you have to apply 12.5% tax in excess of 12.5%. In I think so it is 112A capital gains. Yes, 112A capital gains. So you have to take 12.5% tax in excess of 1.25 lakhs, and other income you will apply 22% tax, 10% surcharge and 4% cess. I hope it is clear to all of you. Coming to the next question, which is on trust. There is a charitable trust which is registered under 12AB. What are they doing? There are 3 independent situations. We need to answer all 3 of them one by one. First charitable trust is registered as advancement of any other object of general public utility. Now, do you remember that? If you are a charitable trust which is registered as advancement of any other object of general public utility, then you can claim exemption only if your commercial receipt is up to 20% of total receipts. Now, in this case, the commercial receipt is 45 lakhs and the total receipts of the trust is 190 lakhs. Therefore, the commercial receipts divided by total receipts 45 lakhs divided by 190 lakhs is greater than 20%. Therefore, the trust will not be eligible for exemption. The trust will not be eligible for exemption in this case. I hope it is clear to all of you. So, what is commercial receipt? Commercial receipt means the fees which you charge to your customer. The amount which you charge to the customer deliberately for providing the service, that is called as commercial receipts. So, that should be up to 20% of total receipts. So, it is exceeding 20%. Therefore, you will not get exemption. Sir, will my registration also get cancelled? Registration will not cancel. Only exemption will be denied to your registration. You can continue. I hope it is clear to all of you. Second question. Good question, intelligent question. There is a charitable trust which is engaged in vocational training. They are providing some training. They have a training institute. They are providing some certificate courses for sewing machines, for handloom weaving, for handicraft. At the same time, this charitable trust also has a clothing shop at the entrance of the training institute. The shop derived 40 lakhs from sale of clothes, and whatever money they have derived, they are using for the purpose of training. They are maintaining separate books of accounts also for the separate books of accounts for the shop. So there are 2 things which the trust is doing. One, trust is providing training to the students. Another trust also has a shop from which they are selling clothes and they are earning money. Whatever money they are earning from selling the clothes, they are using for the purpose of training. They are maintaining separate books of accounts also. Can they claim exemption? The answer is yes. A charitable trust can have a business activity which is incidental to the business. A charitable activity which is incidental to the business is allowed, provided the money should be applied for charitable purpose and they should maintain separate books of accounts. So here, whatever money is coming from sale of cloth, they are applying for the purpose of what? Training institute, and they are maintaining separate books of account. Therefore, they are eligible for claiming exemption under section 11 and 12. I hope it is clear to all of you. Next question. There are 2 charitable trusts. One is engaged in clean drinking water. Another is engaged in water for all. Now they want to get merged. Both of them are registered under 12AB. Now they want to get merged and they have a question whether if they merge, whether exit tax will apply to them. Now for that purpose, the government has brought a new section in Finance Act 2024 by the name 12AC. 12AC says that if you fulfill three conditions, we will not apply exit tax. Condition number 1, both of them should be registered trust. One trust getting merged with another trust, both should be registered under 12AB or 1023C. Second, their object should be similar. Here the objects are similar. Drinking water, clean drinking water, water for all. It is a similar object. It is relating to water. So the object should be similar. And the third condition, they should fulfill some prescribed condition which the government has not yet prescribed. So as of now, only two conditions are there technically. Both of them should be registered trust under 12AB or 1023C and their object should be similar. If these two conditions are fulfilled, you can merge with another trust without worrying about what? Without worrying about the implications of exit tax. No exit tax implication will be applied on you. I hope it is clear to all of you. Next question, which is on TDS now. There are some independent situations in which TDS provisions will be asked. First, there are some amendments which are there, which I will tell you the amended answers. Some of the answers are not amended, but listen to my answer. Don't see the solution in this paper at least. Only this paper is of Jan 26, so therefore this is an old paper. The rest all are amended by me. Now, Mr. Rajesh is a lottery distributor. And Golden Lottery Agency is a very old lottery agency. It has a turnover of 98 lakh rupees in the last year. The last year turnover is 98 lakhs and they are giving Mr. Ramesh some commission of 18,000 rupees first and then 14,000 rupees later. Is Golden Lottery Agency liable to deduct TDS? The answer is yes. Under 194G, Golden Lottery Agency, which is a distributor, they will deduct TDS of the lottery agent. What is the threshold? The threshold is 20,000 rupees. The annual payment should exceed 20,000 rupees, then they should deduct TDS at the rate of 2%. Sir, the last year turnover is less than 1 crore, not relevant. Last year turnover is less than 1 crore, more than 1 crore. Those things are relevant for individual HUF under 194A, 194C, 194H, 194I, 194J, 194R, 194S, 206C subsection 1 and 206C subsection 1F. That is relevant in these 9 sections. That is not relevant in 194G. In 194G, they have just given us to confuse. In 194G, you are not supposed to see the last year turnover. I hope it is clear to all of you. Second question of TDS. Smart Switch Private Limited. It's a platform. It's a platform which is selling cryptocurrencies like CoinDCX, WazirX. Now, Mr. Aarish has purchased some cryptocurrency for 1 lakh rupees in 2024. November 24, and he has sold that cryptocurrency in December 24 at a profit of 347. Therefore, he has purchased for 1 lakh and sold at a profit of 347. Therefore, he has received 447. Selling price is 447. So, I am buyer, you are seller. I am buying something from you for 447. You are selling something to me at 447, but I am buying through exchange. You are also selling through exchange. Who will deduct TDS? The TDS will be deducted by the exchange. I will not deduct. The buyer will not deduct. The TDS will be deducted by exchange at the time of credit or payment, whichever is earlier, at the rate of 1% under 194S on the sale consideration. What is the sale consideration? The sale consideration is 447, not 347. 347 is profit. When the buyer is buying from Aarish, Aarish is selling na, buyer is buying. So the buyer is buying at 447 na, Aarish is selling at 447. Therefore, the cryptocurrency agency, that is the cryptocurrency platform, that is CoinDCX, DCX, and in this case, Smart Switch Private Limited will deduct TDS at the rate of 1% on 447. I hope it is clear to all of you. Next question, question number 16, which is on assessment procedure. There is an assessing officer who has taken an approval from Principal Commissioner and directed that Greenfield Textile has to get their books of accounts audited under 142 2A. So he has given a direction for special audit under 142 2A. Okay. Now the Commissioner has appointed the Chartered Accountant. Principal Commissioner has appointed the Chartered Accountant. Now the Chartered Accountant is not doing the audit on time. Deliberately he is delaying the audit. He is not doing the audit. Because of that, there is a delay in the audit, and therefore the assessing officer said that because the Chartered Accountant is not doing the audit, I will apply what? I will apply best judgment assessment on the assessee. Now the question over here, which came in front of Supreme Court in the case of Swadeshi Polytechs Limited, whether 144 can be imposed on the assessee if the Chartered Accountant is not doing the audit. There is no mistake of assessees. Assessee is completely cooperating. But the CA is not doing the audit for any frivolous reason. Frivolous means any hopeless reason. There is no reason. Can the assessing officer impose 144? The Supreme Court said that no. If there is a mistake, if there is a delay, If there is a non-compliance by chartered accountant, then the assessee cannot bear the burden of 144. The AO cannot impose 144 on the assessee. If assessee does not cooperate in audit, then the AO can impose 144. But if the CA is not cooperating, or if the CA is frivolous reason he is not doing the audit, or hopeless reason, unnecessary reason he is not doing the audit, you cannot impose 144 on the assessee. I hope it is clear to all of you. Next question. There is a partnership firm. Very simple question of penalty. The total income of the partnership firm is 40 lakh as per return. Then income processed at 42 lakh. Income assessed at 58 lakhs. It is not on account of misreporting. Therefore, you have to compute penalty at the rate of 50%. Now you are supposed to compute the penalty. How will you compute the penalty? Very simple. Income assessed at 50 lakhs, 58 lakhs minus income processed at 42 lakhs. 16 lakhs under reported income. Now you will compute tax on 58 lakhs first, then you will compute tax on 42 lakhs, then you will take the difference. On then that you will apply 50% penalty. Now they are asking one more question. Can we waive this penalty? Is there any way we can get immunity from imposition of penalty? If yes, what are the conditions? Yes, you have to fulfill 270AA. First of all, in 270AA, only 50% penalty can be waived. 200% penalty cannot be waived. In this case, the penalty is 50%. Therefore, it can be waived. If this would have been misreporting, 200% penalty, then 270AA would have not been applicable. So, what are the conditions that I have to supposed to fulfill? Listen the condition. Condition number 1. The first condition that I am supposed to fulfill is you have to make an application to the assessing officer within 1 month from the end of the month in which the order is received. Which order? Assessment order is received. Second condition, you have to pay the tax and interest within 30 days from the receipt of notice of demand. These two things you have to do. Third thing, you should not appeal against this order. Against this order, you should not appeal. Appeal is not possible against this assessment order. Then the assessing officer will pass the order. This is an amendment within 3 months from the end of the month in which the application is received. Earlier, this was 1 month. Then the assessing officer will pass an order. In order, he can say two things. One, he is waiving your penalty. If he is waiving on penalty, great. If he is not waiving your penalty, then you can file an appeal against your original assessment order. So these are the things which are given in 270AA. Let's go ahead with the next one. Question number 18. There is a foreign company outside India which has a branch in India. Now there is a foreign company outside India or a non-resident outside India. They have a branch in India. They are allocating some head office expenses of 1 crore 85 lakhs in India. Will they get deduction in India? Yes. As per 44C, they can get. But how much? Amount allocated, that is 1 crore 85 lakhs or 5% of adjusted total income, whichever is lower. What if the adjusted total income is a loss? In this question, adjusted total income a loss. Adjusted total income is a loss in this case. Therefore, you have to take average adjusted total income of last 3 years. So if the adjusted total income is a loss, you have to take average adjusted total income of last year. Therefore, last 3 years adjusted total income is given. We need to find out the adjusted total income of last 3 years, and then we have to add all 3 of them, then divide by 3. That will be our average adjusted total income. Take 5% of average adjusted total income, compare with actual amount allocated, 1 crore 85 lakhs, whichever is lower will be allowed as deduction. Now, how to find out average adjusted total income? They have already given us total income, which is after all the items. Should I add depreciation? Do not add depreciation. We do not add depreciation to adjusted total income. Should I add addition? Should I add unabsorbed depreciation? Yes. UAD is added back. Should I add chapter 6? Yes. Chapter 6 is also added. You have to do this for all 3 years, and find out three adjusted total income. Then take average of all 3 of them, and then take 5%. Should I add brought forward short-term capital loss? Yes. Brought forward short-term capital loss should be added back. It is written in the law, brought forward losses. Should I add current year long-term capital loss? No, current year losses are not added back. Only brought forward losses are added back. Should I add brought forward speculative loss? Yes, add back that. Should I add VRS? Do not add VRS. This is already 1/5. If this would have not been 1/5, then we would have added back 4/5. This is already 1/5, so it is correct. If this would have been full amount, then we would have added back 4/5, because only 1/5 is allowed for VRS. Should I add back head office expense? Yes, head office expense definitely add back. After adding all these things, you will get 3 adjusted total income. Take total of all 3, divide by 3, multiply by 5%. Compare that with actual. Whichever is lower will be allowed. I hope it is clear to all of you. Next question is on safe harbor rule. Transfer pricing with safe harbor rule. High chances it can come in the examination. Be very careful. There are 3 transactions. We need to find out whether safe harbor will be applicable or not. First of all, we need to identify whether both the entities are associate enterprise or not. First of all, the services are provided by Tech Mitra Solution, an Indian company, and it is provided to Blue Orbit Solution, and both of them are associated because one entity holds 30% voting power in another. Therefore, both of them are deemed to be associate enterprise. This is the first thing. Second thing, we need to find out the nature of service. The nature of service is provision of software development services, which is nothing but provision of support services, which is nothing but software development services, and software development services is covered in safe harbor rule. Therefore, now we need to find out the transaction limit and the percentage. The transaction limit, if it is up to 100 crore, in this case it is 99 crore, you have to show a margin of 17%. Now let's see how much margin they are showing. How to find out margin? Operating profit upon operating cost. Operating profit is 8 crore, operating cost is 50 crore, therefore this is 16%. No, you have to show minimum margin of 17% because your actual margin is only 16%. Safe harbor is not applicable in your case. Sorry, the doors of safe harbor are closed. Second transaction, this next era system Indian company and this new Neurocore technology is a foreign subsidiary, therefore both of them are deemed to be associate enterprise. Now we will find out whether the service is covered in safe harbor or not. Provision of data processing services with the use of information technology, yes, it is IT enabled services. Go and check the definition of IT enabled services, you will get that over here. Now here, if the transaction value is up to between 100 crore to 300 crore, more than 100 crore up to 300 crore, which is our case is 255 crore, 265 crore, sorry, the margin should be 18%. If it is 18% or more, we will accept safe harbor. If it is less than 18%, we will not accept. Minimum 18% you have to show. Now what is the margin? The operating profit is 45 crore, operating cost is 225 crore, the margin is 20%, which is more than 18%, therefore the officer will accept safe harbor. I hope it is clear to all of you. Third one, there is a partnership firm and there is another entity, Pragati and there is another entity, Stratosphere Innovation, which holds 12% in the partnership firm. So if I am a partnership firm and somebody holds 10% or more, if I am a partnership firm and if somebody holds 10% or more in our company, then in our partnership firm, then we both are associate enterprise. Now, what is the service they are giving? They are giving provision of contract research and development services. Is it covered in safe harbor? Yes, it is covered in safe harbor. Now, if your transaction value is up to 300 crore, in this case it is 175 crore, you should show a margin of at least 25%. Now, what is the margin? 50 crore divided by 250 crore, the margin, actual margin is 20%, which is lower than safe harbor margin. Therefore, safe harbor is not applicable. Now, one last question which is asked over here. Will your answer change if the services are provided to an entity which is located in notified jurisdiction area? Yes. I have told you and I have told you this is important also. When you provide services to a person which is located in an NJA, safe harbor rule is not applicable. Safe harbor rule is not applicable in NJA. So if you provide all these three services to a person located in what? To all these three services if you provide to a person which is located in NJA, then safe harbor rule is not applicable in all these three cases. What is NJ? NJ is notified jurisdictional area which the CBDT may notify. Earlier they have notified Cyprus, then they have removed Cyprus. As of now, there is no country which is officially declared by Government of India as an NJ. But yes, in exam they can ask country X is an NJ, country Y is an NJ. Hypothetical question can be asked in the examination, which they have been asking again and again. Next question is a DTAA question. Ritika is aged 30 years, resident individual. He has a business in India and also abroad in country Z. We are supposed to compute total income of Ritika and tax of Ritika as per DTAA. India, as per 115 BSc subsection 1A means as per new regime. India does not have DTAA with country Z. Let's compute the tax liability of Ritika here. What all things will come in Ritika's income? First of all, income from selling of phones, skins and covers, 12 crore 45 lakhs minus expense of 10.2 crore. This will be the net income. Similarly, income from country Z 15.5 lakhs minus 9 lakhs, the 6.5 lakhs income from country Z. Then commercial property rent 7 lakh 80,000, 65,000 into 12 minus 30% standard deduction, expenses not allowed. Then Ritika also has employed few employees. So she is eligible for 80 JJAA. 18 employees employed on 1st of May. Emolument is less than 25,000 rupees. Employees are employed for more than 240 days. Therefore, 80 JJAA eligible. 18 employees into 11 months into 23,300 into 30%. For these 22 employees also eligible because employees are employed for more than 240 days and emolument is also up to 25,000 eligible. Last not eligible because the employees are employed for less than 240 days. All of them participate in recognized provident fund. Yes, it is necessary. If you want to claim 80 JJAA, the employee should participate in recognized provident fund. Yes, the payment should also be made by online mode. After doing all these things, you will get total income of what? Ritika. After that, you compute tax. Now, the catch in this question is, in this question, there is coming marginal relief. Why? Because the total income of Ritika is coming to somewhere around 2 crore 7 lakhs. Now, if I compute tax on 2 crore rupees and surcharge on 2 crore rupees, then I compute tax on 2 crore 7 lakh rupees, the extra tax is coming more than the extra income. The extra tax is coming more than the extra tax is coming somewhere around 9 lakh. The extra income is coming only 7 lakh. Therefore, marginal relief you have to apply here. So, the solution I have made over here, because this is old solution, only this question is old in the entire PDF. Only this question is old. Rest all solutions are updated. So for this solution also I have given updated solution here. So first you will compute tax on 2 crore and surcharge on 2 crore. What is tax on 2 crore and surcharge on 2 crore? Apply slab rates, then apply 15% surcharge. You will get 64 lakh 17,000. Then extra income is 745. Add extra income. Add extra income and then add cess on that, you will get your tax. And then you will find out the what? Then you will find out the double taxation relief. I hope it is clear to all of you. So marginal relief is the catch in this question. Otherwise your answer will go wrong. Huh? You need to be very careful when you are close to the marginal relief income. I hope it is clear to all of you. So this is what this RTP is all about. Now let's go ahead with one last RTP, that is RTP May 2026. After this we will be completed with 9 RTP compilation exhaustively in full English along with our Hindi division also. Okay. So the very first question again over here is on total income. There is a domestic company. We need to compute the total income, etc. Let's see the last line, what exactly they want. They want us to compute total income, tax liability under regular provision. Ignore MAT. Then also they have asked us to compute the total income as per 115BAA also. The turnover of last year is 350 crore. Therefore, the tax in the current year will be how much? Will be 25% because the turnover is not exceeding 400 crore rupees. Now let's start with the solution as per normal provision first, and then we will compute the solution as per the provisions of 115BAA. The depreciation as per the books of accounts will be added back. Then employer contribution and employee contribution of March. Employer as well as employee contribution of March is paid in the month of July. Is it correct? No. Employer contribution you can pay up to the due date of filing of return, it is allowed. But employee contribution has to be paid up to 15th of the following month. So employer contribution is correct, but employee contribution is wrong. Therefore, employee contribution in this case will be disallowed. I hope it is clear to all of you. Then you are giving some contribution of 1.5 lakh to a scientific laboratory, scientific research association, etc. Therefore, that is allowed under section 35, but in 115BAA it will be disallowed. Be very careful. In 115BAA it is not allowed as a deduction. Next one, you are incurring some advertisement expenses of 55,000 rupees, which is paid by account pay check. Till here it is good. But you are giving this advertisement in a political party brochure. Now that is not allowed in PGBP over here. In PGBP it will not be allowed, but under 80 GGB you can claim as a deduction. Under normal regime in 115BAA this will not be allowed as deduction. So again I am saying advertisement in a brochure of a political party is not allowed as a PGBP expense. But under chapter 6A you can claim as a 80 GGB deduction, but under 115BAA you cannot claim. Next is a very routine adjustment again. Provision for gratuity based on actuary, that will be disallowed under 40A7, and whatever provision is paid, that will be allowed under PGBP. So 1.2 lakhs will be disallowed and 5 lakh will be disallowed. Next one, opening stock is overvalued by, opening stock is overvalued. Now if your opening stock is overvalued, it means you are claiming more expense. If you are claiming more expense, you have to add back. So you cannot claim more expense now. Opening stock is overvalued, but that means debit side of the P&L is overvalued. Debit side of the P&L is overvalued means you have claimed more expense, your profit is less, so increase the profit. Closing stock is overvalued. If closing stock is overvalued, it means your income is overvalued unnecessarily, so reduce. So the opening stock overvalued will be added back and the closing stock overvalued will be reduced. Then dividend from foreign company reduced from here, show under IFRS, very routine adjustment. Then profit on equity oriented fund on which STT is paid. So this will come under 112A. How much profit is there? 7 lakh profit is there. So reduce 7 lakh from here and show under what? Show under capital gains under 112A. It will be taxable at 12.5% in excess of 1.25 lakhs. Sir, what is the consideration of this? The consideration of this will be 11 lakhs. How, sir? See, the profit is 7 lakh and the units were acquired 2 years ago, before 2 years ago for 4 lakh rupees. Therefore, the full value of consideration is 11 lakh, cost of acquisition is 4 lakh, profit is 11 lakh. Again, I am saying the treatment, reduce 7 lakh from here and show 7 lakh under capital gains, 112A because it is long-term capital gains, 12.5% tax in excess of 1.25 lakhs. Then there is some cash lost due to theft. So it's okay, it's a part of business, it's a revenue expenditure, you can claim that as a revenue loss and therefore it is allowed. Since it is already debited to P&L, you don't have to do anything, just write a note. Next, depreciation on tangible fixed asset, 8,50,000 you can claim as a deduction. Then you have purchased some power generating units on 1st of July for 25 lakhs. Now, you need to be very careful. The payment is made as follows. First, you made the payment, advance payment of 3 lakh rupees in cash, not allowed. It is written in section 43(1). If you make a payment for a fixed asset in excess of 10,000 rupees to a person in a day by other than 4 modes, then that expenditure shall not form part of actual cost. You are making the payment of 3 lakh rupees here in cash, therefore this will not form part of actual cost. So out of 25 lakhs, reduce this 3 lakhs. Then out of this 25 lakhs, 7 lakh is given as a government grant. So government grant should also be reduced from actual cost. As per explanation 10 to 43(1). Any amount which is made by any person should be reduced from actual cost as per explanation 10 to 43(1). Then the remaining payment is made by check through banking channel of 15 lakh rupees. Therefore, this will be part of actual cost. So therefore, eventually what will be the actual cost? 25 lakhs minus 3 lakhs minus 7 lakhs. Therefore, the actual cost is only 15 lakhs. On 15 lakhs, claim 15% normal depreciation, 20% additional depreciation because the asset is put to use for more than 180 days. But in 115BAA, you will not get the deduction of additional depreciation. That time you add back. Okay. Next one. The company paid cash in the current year for purchase of raw material of last year. So last year you purchased some raw material, you claim deduction on accrual basis, and in the current year you paid 85,000 cash. Therefore, this will be deemed income in the current year. So in the last year you claimed 85,000 as a deduction on accrual basis. Now in the current year you should make the payment by 4 modes, but you have not made the payment by 4 modes. You are making the payment by cash. Therefore, it will be deemed income in the current year. Next, you have purchased some raw material of 18 lakhs, but due to poor quality, you are making payment of only 14 lakhs. 4 lakh is remitted and seized by the creditor. So out of 18 lakh purchase, 14 lakh is payable, 4 lakh is remitted by the creditor. Therefore, 4 lakh will be deemed income under section 41(1). Remission or cessation of a trading liability is deemed income. Therefore, this 4 lakh you have to add to your income. Okay. I hope it is clear to all of you. Next, you are distributing dividend of 1.5 lakhs in the current year. Okay. How much dividend you are distributing? 1.5 lakhs on 15th of October. Late. You cannot claim ATM. To claim ATM, you should distribute dividend 1 month prior to the due date of filing of return. What is the due date of filing of return of this assessee? 31st October. Sir, why not 30th November? See, it is written in the question, the assessee has not entered into any international transaction. Therefore, 30th November is not possible. Only 31st October is possible. If 31st October is the due date, you should distribute the dividend by 30th September. You are distributing the dividend on 15th October. Therefore, provision of ATM will not be allowed. After that, you have to compute tax. 2 tax will come, 112A. 12.5% in excess of 1.25 lakhs, and normal income will be taxed at 25% because the turnover of last year is below 400 crore. Now in 115BAB, what will you do? In 115BAA, sorry, 3 items will be added back. First, additional depreciation on this machinery will be added back. Then 80 GGB, that advertisement donation will be added back, and then scientific research donation will also be added back. 22% tax on special income, 12.5% in excess of 1.25 lakh, then 10% surcharge and 4% cess, and then find out whichever is more beneficial. I hope it is clear to all of you. Next question is on charitable trust. There is a charitable trust. Point number 1. Sahitya Charitable Trust, main object is medical relief. Now they are earning some incomes. First income, they are earning income from tax-free bonds, 1,10,000, which is exempt under tax section 1015, and second is agriculture income, which is exempt under 10.1. So their question is, they are a charitable trust, can they claim both the exemption? The answer is no. I have told you this earlier also in earlier RTP, that if you are a charitable trust registered under 12AB, then you cannot claim any exemption under section 10 except 10.1. 10.1 you can claim. Therefore, in this case, you can claim 10.1, 10.15 you cannot claim. Therefore, in this case, the first one you cannot claim, the second one you can claim. I hope it is clear to all of you. The institute has already given, the first one is covered under 10.15, the second one is covered under 10.1. So they have also given the section number, so it's okay. If they would have not given section number, then there would have been some problem. We need to think about it where it is exempt. But anyways, anything apart from agriculture income is not eligible. You have to think like that. You don't have to remember each and every section. Next trust. Jyoti Vidya Jyoti Educational Trust, registered under 12AB, they own a building. So the trust own a building. Now they are giving this building on rent to a private coaching institute which is owned by the wife of the founder of the trust. Now the wife of the founder of the trust is considered to be specified person under section 13 subsection 3. Now you cannot give unreasonable benefit to specified person. So if you are giving that building on rent to the wife of the founder, it is okay. There is nothing wrong, but give at market value. If you give unreasonable benefit, then the trust will be gone. So you are giving at a rent of 20,000 per month, whereas the market rent is 70,000 per month. Now you are making a mistake. You should not give at 20,000, you should give at 70,000. So what will happen to the trust? Multiple implications. First of all, 115 BBI will apply, specified income, 30% tax. Then penalty will be applied 271 AE. If you pass unreasonable benefit to your specified person, first time the penalty will be 100% of the unreasonable benefit given. Second time it is 200%. Then whatever rent they are earning, how much rent they are earning? They are earning a rent of 20,000 rupees. This part of income is not eligible for exemption. On this 20,000 rupees, they will not get 15% exemption. They cannot apply and claim exemption also. So 3 implications you have to keep it in mind. Similarly, next trust is also doing something similar only. There is an Arogya Welfare Charitable Trust, which is providing free medical facilities to poor people. Now, in this case, there is one person by the name called as Mr. Karan who has contributed 75,000 rupees to the trust in the current year, and till last year he has contributed 9,50,000 rupees. So, is Mr. Karan a specified person? The answer is yes. There is an amendment in the definition of specified person, if you remember. Who is a specified person as per the amended definition as per Finance Act 2025? If a person is contributing more than 1 lakh rupees in a financial year, he is a specified person. No, Mr. Karan is only contributing 75,000. Therefore, because of this reason, he is not specified person. Second condition, if a person is contributing aggregate amount to the trust till the last day of the financial year of more than 10 lakhs. Is Karan contributing more than 10 lakhs? The answer is yes. Till last year, Karan has contributed 9.5 lakh. In the current year, Karan has contributed 75,000. Therefore, the aggregate contribution by Karan to the trust is 10 lakh 25,000. Therefore, because of this reason, Karan is a specified person. And now you cannot give unreasonable benefit to the Karan. Now you are doing unreasonable things for Karan. Check. First of all, you have to prove that Karan is a specified person, which I have proved because of this 10.25 lakhs. Now, are you giving unreasonable benefit to Karan? The answer is yes. You are selling some old furniture at 1,20,000 rupees, whereas the market value of the furniture is 2,80,000. So, you are giving unreasonable benefit to Karan of 1,60,000 rupees. You are selling at a cheaper rate, which is wrong. Again, 115 BBI will apply in the hands of the trust, and 271 AAE will apply in the hands of the trust. And this amount which is trust is receiving by sale of furniture, that cannot be subject to exemption under 11 and 12. I hope it is clear to all of you. Next question. Very good question. We have done that in class. It's a Delhi High Court judgment of UCO Bank. CBDT has also accepted this view of Delhi High Court. So it's a well established principle now. Suppose I have gone to court and there is some case going on me. Now the judge is saying that you have to deposit 10 lakh rupees till the time the case is not completed. So I gave 10 lakh rupees as a security to the judge. Now what will the judge do? The registrar of the court will deposit that money in the bank and will earn some interest. Now the bank is paying some interest to the registrar of the court. Will bank deduct TDS under 194A of the registrar of court? The Delhi High Court in the case of UCO Bank has said that no. This is not our income. This is not the income of the court. We are just doing it on behalf of what? On behalf of the person who is fighting the case. So therefore, whatever interest which is paid by banks to the registrar of the court will not be subject to TDS. Registrar of the court is not payee for the purpose of 194A. The payee is ultimately who? The person who will win the case. And who will win the case? That only time will say. Now I cannot say. Therefore, this amount which is paid as an interest by registrar of court to by bank to the registrar of court will not be subject to TDS. I hope it is clear to all of you. Next question has 4 transactions. You need to say whether TCS will apply or not. First transaction, the assessee is selling some timber under forest lease. So whether TCS is applicable? Yes. 2% TCS is applicable at the time of debit or receipt, whichever is earlier. See here, the assessee is Messrs. Green Resource Limited. It is engaged in extraction of foreign produce and minerals. It is selling some timber under forest lease to Messrs. Buildwell Infrastructure Private Limited. So on this transaction, 2% TCS will be applicable. Then there is some scrap which is sold by assessee to resident. Now scrap is sold by assessee to resident. This will be subject to 1% TCS under 206C subsection 1. This is also covered in 206C subsection 1. This is also covered in 206C subsection 1. Third, the assessee is selling some coal to a resident and the buyer is giving a declaration that he will use this coal for generating power. He will use this coal for generating power. Therefore, you should not deduct. You should not collect TCS. So in the third case, the assessee is supplying coal, but the buyer is saying that I will use this for electricity purpose. I will not use this for trading purpose. So in that case, TCS is not applicable under 206C subsection 1A. Fourth one, you are giving toll plaza on lease. So if you give on toll plaza on lease or parking lot on lease or mines on lease or quarry on lease, you should collect TCS under 206C subsection 1C. But if you give this to public sector undertaking, then TCS is not applicable. Go and check. Such minute things they are asking. If you give this to public sector undertaking, then TCS is not applicable. I hope it is clear to all of you. Next question is on provisional attachment. Let's try to understand what is this question all about. First of all, the regular assessment for AY 23-23 of the SSC, 23-24 of the SSC was completed on 16th of July 2025. Okay, regular assessment completed. Then income escaping assessment notice has come on 18th of January 2026. During the income escaping assessment, the AO wants to attach the house property of Miss Preeti. So the AO wants to do provisional attachment provision under section 281B. Now we need to answer three questions. First, the circumstances under which the AO can make provisional attachment of the property. So 281B says that if there is a pendency of assessment and if the officer has taken approval from principal director general, principal chief commissioner, etc., and it is in the interest of the revenue to protect the revenue of the government, then they can do provisional attachment under 281B. So three conditions has to be fulfilled. First of all, there has to be a pendency of assessment. Secondly, they have to take approval from higher authority, and then they should have a opinion that it is in the interest of the revenue. Second, what is the time period for which such attachment can be made? They can provisionally attach your property for a period of 6 months from the date of order. Can that be extended? Yes. The officer has to record the reasons in writing. They have to record the reasons in writing. Then it can be extended for a period of 2 years or 60 days from the end of the completion of assessment, whichever is later. So it can be extended for 2 years, or if the assessment is completing later, then 60 days from the completion of assessment, whichever is later. Can such attachment be, provisional attachment be revoked by AO once he has attached? Now, can he revoke that? Can he leave that property? Yes, he can leave in writing. He will revoke in writing provided the assessee has to fulfill some condition. First, assessee has to give a bank guarantee. Second, the bank guarantee should be given from a scheduled bank. Third, the bank guarantee should be equivalent to the FMV of the asset. If these conditions are fulfilled, the AO will revoke the bank, it will revoke the provision attachment order, and the property will be given back to you. Next question we have already done. You can check it earlier. I'll just give you the synopsis also if you don't remember. We have done in earlier RTP. There is a foreign company which has become resident in India due to poem. So now the foreign company has become resident in India due to poem. Now that foreign company is foreign company also. That foreign company is resident also. Now we are making some payment of professional fees. So should I deduct TDS under 194J or 195? So the law says that you have to deduct TDS under 195 and not under 194J. So that is what this question is all about. So we have done this similar question earlier. Same to same question we have done earlier. Now the next question is a very good question on business trust. Mr. Ricardo, who is a non-resident, is holding 10% units of the business trust, and the business trust has distributed the following income to Mr. Ricardo. Always remember now, in this question, this is not the income of the trust. This is the income of Mr. Ricardo directly. They have directly given us 10% income of Mr. Ricardo. So don't do again 10% of this. Your answers will go wrong. Okay. So they have directly given. See, they have given information that Mr. Non-resident holds 10%, and they have given that these amounts are given to non-resident only. So these are not the total income of the trust. These are the distributed income which is given to Mr. Ricardo. I hope it is clear to all of you. Now we need to answer the following things. One more information is given that Grey Limited does not exercise. Who is Grey Limited? Grey Limited is SPV. SPV does not exercise the option under 115BAA. That is very important for taxing dividend income. First of all, let's try to understand one by one. Rental income from real estate property. What will happen? Rental income from real estate property is exempt in the hands of trust. Business trust taxable in the hands of investor under 194 LBA. The investor, the company will deduct TDS. The trust will deduct TDS. So if a business trust invests in land and building, earns rental, exempt in the hands of business trust, taxable in the hands of investor. Investor is non-resident, therefore deduct TDS under 194 LBA at rates in force. Rates in force is the highest rate applicable to the Mr. Ricardo, that is 30% tax plus 4% cess. Interest income from SPV. Again exempt in the hands of business trust, taxable in the hands of investor. Because investor is non-resident, you should deduct TDS at 5.2%. 5% tax, 4% cess. Dividend income. What is the treatment of dividend income? Dividend income exempt in the hands of business trust, always. In the hands of investor also exempt. Why? Because the company, the SPV is not following 115BAA. If SPV is not following 115BAA, the dividend is exempt in the hands of the investor. But if SPV is following 115BAA, If SPB is following 115BAA, it is given in the last line. Assume that SPB follows 115BAA, then what will happen? Then it will be taxable. And you have to deduct TDS at the rate of 10%. I hope it is clear to all of you, plus cess. Last but not least, apart from rental income, interest income and dividend income, the business trust is also distributing 2 crore rupees to all the unit holders. It means to Mr. Ricardo, they will distribute 20 lakhs to all unit holders. See, somewhere they are writing only Mr. Ricardo's share. Somewhere they are writing to all unit holders. You need to be very careful with the wordings in the question. So the above information is for only Ricardo. The below information, 2 crore is for all. So Mr. Ricardo is getting 20 lakh rupees over and above these three items. That is nothing but debt repayment. So there 56 to 12 will apply. What is 56 to 12? Any amount which is given over and above rent, dividend, interest, etc. that will be taxable as IFOs in the hands of the investor. How much IFOs? Whatever is given as debt repayment minus whatever is the price of the units purchased in business trust. What is the price of the unit purchased in business trust? 15 lakhs. And what is the amount given over and above all these items? Over and above all these items 20 lakhs, and the unit business trust units cost is how much? 15 lakhs. 5 lakhs rupees will be taxable as income from other source in the hands of Mr. Ricardo. No TDS is applicable on that provision. So the government has not put any TDS on that particular part of the income. No TDS provision is applicable on that income. I hope it is clear to all of you. Now the next question is very good question. Just one change I have to make. I have to write down here. What I have to write down here? 6.4 crore. That is not 7.2 crore. That is 6.4 crore. Now to explain this entire question, I have put this example. Try to understand this example first of all. Trex Inc. Trex Limited is an Indian company. They have taken some loan from Mrs. Refine Inc. last year 90 crore, but last year they have repaid 10 crore. Therefore, effectively the loan is only 80 crore. Okay. Now they are paying interest on 80 crore, 6.4 crore, 8%. Trex Mrs. Refine Inc. is what? Is a third party. Mrs. Refine Inc. is not our associate enterprise. So we are paying 6.4 crore interest at the rate of 8% on 80 crore, 10 crore is repaid. Therefore, this 6.4 crore interest we are paying to third party. Now there is one company, Prestige Inc., which is giving guarantee to our associate enterprise. Now there is one more company, Bright Inc., which is holding 40% in Trex and 40% in Prestige. Therefore, because Bright Inc. holds 40% in Trex, 40% in Prestige, therefore Trex and Prestige are associate entity. Therefore, Trex and Prestige are associate entity, and our associate entity is giving guarantee to third party. Therefore, this interest will be coming under limitation of interest. As simple as that. So again, I am saying Prestige is now eventually our what? Prestige is eventually our associate enterprise. Prestige is our associate enterprise. Why? Because Bright holds 40% in us, 40% in Prestige. Therefore, we and Prestige are associated. An associate entity gives guarantee to Mrs. Refine Inc. Therefore, the interest paid to Refine Inc. will be coming under limitation of interest under 94B. Now, the question is that there is some disallowance of last year also. Last year also some disallowance is there of 7.5 crore under 94B. How much we can claim in the current year as a deduction? We can claim up to 30% of EBITDA. For that, we need to find out EBITDA. EBITDA is how much? 18 crore is your net profit. Add interest in that 6.4 crore. Add 4 crore depreciation and add 2.7 crore tax. 31.1 crore is your EBITDA. Up to 30% will be allowed in the current year. What is 30% of EBITDA? In excess of 30% is disallowed as per 94B. It means up to 30% is allowed. Therefore, 30% will be allowed in the current year. Therefore, 9.33 crore will be allowed in the current year. Now, 9.33 crore interest you can claim in the current year, out of which 6.4 crore is current year interest. Therefore, remaining 2.93 crore you can claim for last year. So, out of 7.5 crore, you can claim 2.93 crore in the current year, and balance out of 7.5 crore, you can carry forward for the next years. I hope it is clear to all of you. It's a good question. We have done a similar question earlier also. And one last question over here, which is on DTAA. Shrestha, resident individual, 34 years. He is earning some income from the various country. India does not have DTAA with foreign country. He has not opted out of default regime. See, they are playing with language, English. Is this a tax paper or English paper? I don't understand. He is not opted out of default regime means she is following default regime. It means she is following new regime. They could have easily said, is following default regime. No, but she is not opted out of default regime. It means she is not going out of default. It means she is remaining in default. It means she is following new regime. What the hell is this? Is this an English paper or a grammar paper or a tax paper? I don't understand. Anyways, whatever is there, We have to take care of it. Now let's try to compute the income. First of all, she is earning income from business from Jaipur. On that, she is incurring expense of 3.5 lakhs. So the net income is 26 lakhs minus 3.5 lakhs. Then she is earning the rent from country M, 95,000 rupees per month minus 30% standard deduction you will take. Expenses will not be allowed in India. Only 30% standard deduction allowed. Then she is earning agriculture operation income of 18 lakhs. On that, she is incurring expense of 8.5 lakhs. So 9.5 lakhs will be taxable. Then she is earning dividend income from country M, IFOS. Now, agriculture income is exempt in country M. So this is not doubly taxed. This will not be doubly taxed because this is exempt in country M and only taxable in India. Okay. So we have to compute total income. So total income will include what? 26 lakhs minus 3.5 lakhs. Then 95,000 minus 30%. Then 18 lakhs minus 8.5 lakhs. And then 4,20,000. Then you have to compute tax. After you have computed tax, now you need to find out doubly tax income. Now the most important catch over here is doubly tax income. Which incomes are doubly taxed? Is this first income doubly taxed? No, because this is Indian income. This is not doubly taxed. Is this second income doubly taxed? Yes, this is doubly taxed. Is this agriculture income doubly taxed? No, because agriculture income is not taxable in country M, so you cannot say it is doubly taxed. Is this dividend income doubly taxed? Yes, dividend income is also doubly taxed. So two incomes are doubly taxed. I am highlighting with different colors. So this dividend income is doubly taxed and this rent income is doubly taxed. Now dividend income is doubly taxed how much? 4,20,000 and the rate is how much? 20%. Compare with average rate in India, whichever is lower will be allowed as relief. But there is a catch in rent doubly tax income. Rent is doubly taxed in India. In India, rent is taxed at 7,98,000 because 95,000 into 12 minus 30% comes to 798. But in country M, the rent is taxable at 6,15,000 only. Why? Because in country M, the rent is taxable at 95,000 into 12 minus 5,25,000 because in country M, all these expenses are allowed. Therefore, what is doubly taxed in India? In India, rent is taxable at 798 because the deduction is allowed different. In India, it is 30%. In country M, it is 5,25,000. Therefore, in India, the income tax is 7,98,000. In foreign country, the income tax is 6,15,000. Therefore, doubly tax is how much? Doubly tax is only 615. You cannot say 798 is doubly tax. Therefore, on 615, you have to apply whichever is lower rate. I hope it is clear to all of you. And on dividend income, you have to apply on 4.2 lakhs because dividend income is same in both the countries. I hope it is clear to all of you. So this is what this RTP is all about. So here we complete 9 RTPs exhaustively in full English. The next target after this will be to complete 9 past paper including the Jan 2026 paper for your reference exhaustively in the same manner and probably in a better manner if it is possible from my side. I request all of you to do only few things. First, watch this video again and again. Again and again, you try to watch this video as many times as possible. This is the most important video for you. Second thing, you have to make sure that if you want to learn all these things in great detail, I am doing just revision. If you want to learn all these things in great detail, we have covered all these things in great detail in our regular batch, in our exam oriented batch and also in our practical question batch. In this compilation video, we are going to cover around 200-250 videos. But in our regular batch, exam oriented and practical question batch, we have covered more than 550 questions. More than 550 practical questions, and there I have explained each and every point in detail. Here the objective is from the exam day perspective. How will you revise on the day of examination? But if you want to do it in detail, you can enroll for our respective batches in full English, which is available on our website. You can check it over here. Third thing, the PDF of this I have already uploaded on our Telegram channel. You can download the PDF from there. Okay.